useful or relevant. We will try to cover the questions as much as we can, but if we cannot, we do apologize. However, do get in touch with our speakers after the seminar. The Stock Exchange of Thailand encourages minimizing the use of paper, so all the presentation documents can be accessed by scanning the QR codes at the registration desk, or please call our staff on both sides of the seminar room if you need the documents. Now, without further delay, may I invite Mrs. Kesara Manchusree, President of the Stock Exchange of Thailand, to give the welcoming speech for today's seminar.
ค่ะสวัสดีทุกท่านนะคะค่ะขออนุญาตพูดเป็นภาษาอังกฤษนะคะค่ะ President of the Assumption University and all the speakers, distinguished guests, ladies and gentlemen, and good afternoon, everyone. It is my great pleasure to welcome you, and I am pleased to be here for the opening of these special seminars. As we all can see, Thailand's startup community is growing fast. The latest Thailand startup ecosystem reported that by the Tech Source revealed that in the year 2017, over $100 million were invested in the Thai startups, showing highest investment amount in the 6 years. Businesses and operations in Thailand are also rushing to set up their own CVC or the corporate venture capitals. But to maintain the momentum and growth, entrepreneurs and those supporting the ecosystem must work hard to increase opportunities for the success, understanding the challenges, and find a way forward together. Some of many challenges that we may see are the tough competition, unclear business plan, failure to attract talent, or even sudden or unexpected growth where entrepreneurs don't know how to handle the situation. However, one of the biggest challenges that almost all the startups face is lack of sufficient funds. Even in the US, research by the Federal Reserve Bank of New York found that 2/3 of the startup firms face financial challenges. That ratio is probably much more in Thailand. I hope that by the end of today's seminar, we all will have a much better understanding of how to value a startup business, and with that valuation, go forward in seeking appropriate financing. When we talk about the financings or the fundings, of course, the big question is, what are the challenges, what are the channels that entrepreneurs can access funds they need? As a stock exchange and a part of the capital market mechanism, we want to make the capital market work for everyone. This is our vision for the Stock Exchange of Thailand. This means not only large established corporations, but we also want to be another channel to support entrepreneurs of the startup and SME that seek funding for their businesses. So to make this happen, this morning we have officially launched the Live platform, which is our brand new equity crowdfunding and electronics trading platform. This platform uses the blockchain technologies for enhanced efficiency, securities, and transparency, and is operated by Live FinCorp, which is a wholly owned subsidiary of the Stock Exchange of Thailand. I believe that some of you already attend our morning session for opening the Live platform. We have also set up the FCT Enterprise Education since last 2 years. I'm not so sure that you are well aware that for the Stock Exchange of Thailand, we have been doing a lot of education for the investor in terms of investing in the equity market. But during the past 2 years, we realized that it's not only the education for the investor, but we shift our education focus into, we add another type of education. So we add the entrepreneurship education into our education team. So we started last 2 years that we do a lot of education to the potential listing companies, and we also have the education for the startup business. I believe that we already have like over 3,000 people that attend for the startup class, and also that with the kind of instructor, all the university professionals that we already have for over 600 people that attend this class too. That's why for this seminar, for the today, is one of them that I'm sure that it will be many more interesting topics to follow in the future, because of today's seminar would be part of our education for the startup people. And for this seminar, I would like to thank our speaker, Mr. Douglas Abrams, Mr. Jones, Kaaiohelo, sorry that if I'm speaking wrong, and Mr. Paul Arkt, as well as Dr. Pachamaporn or Dr. Nan Sethjinda. I'm sure that their experience in working with the entrepreneurs and startups throughout this region and elsewhere will give us valuable insights into startup valuation, as well their experience when seeking investment opportunities. I hope you all enjoy the seminar. Thank you very much. ขอบคุณนะคะ สวัสดีค่ะ
Thank you very much, Mrs. Kesara, President of the Stock Exchange of Thailand. Next up, I would like to invite Rev.Bro.Dr.Bancha Saenghiran, President of Assumption University, on the stage to give the welcome remarks.
Kun Kesara Manchusree, the President of the Stock Exchange of Thailand, distinguished speakers, honored guests, ladies and gentlemen, may I join Kun Kesara to welcome all of you to this special seminar. It is indeed my great pleasure to witness the excitement among the startup entrepreneurs and their coming interaction with the three most notable venture capitalists. Formally, if you look at the university, you understand very well that the university is the place of knowledge, the only place of knowledge. But when you come to this 21st century, you will observe that the world keeps on changing. And I define this world as the 3C. The first C is change. The second one is competition. And the third one is complexity. So the world are full of these kind of C's there. And if you stand alone, you will not be able to work much. That's why the university, including all the lecturers and faculty members, they cannot live on the pedestal. They have to come down on the earth and walk the earth. That's why at this particular time, we have to join hands with the Stock Exchange of Thailand. So I have to thank the Stock Exchange of Thailand through the President for her graciousness to cooperate with us at this particular time. Assumption University is honored to collaborate with the Stock Exchange of Thailand to host this very special seminar on startup valuation and beyond. And this seminar is special for us for two main reasons. The first one is, and most very importantly, you will all have a unique opportunity to learn about venture capital process, startup valuation, and venture capital term sheet from three highly regarded venture capitalists. You will meet them very soon, the three of them there. And secondly, the seminar represents the fruit of our 10-year partnership with the Stock Exchange of Thailand. And it represents an important milestone of the long-term relationship. And if you look into the TED.com, and look at one clip there, and you will see that there is a kind of what you call a research, and that research has been done for over 75 years. And it has passed through all the 3 directors of the research center of Harvard University. And that center, and after the research, the finding is the most important thing in life of the people, it is not in money, it is not in position, but it is in relationship. That's why at this particular time, I have to thank once again the Stock Exchange of Thailand, because we partner and will cooperate with the Stock Exchange of Thailand to help the educational institution to make our students grow. And we have been over 10 years for this kind of relationship. Okay. And to establish collaboration with the network of young entrepreneurs and professionals. Many sectors of the economies have been going through transformation at different scope and speed. Working together, learning from the best, experimenting and taking initiative through are just a few key actions. We will pursue to see our partnership with the Stock Exchange of Thailand. At this particular time, I just want to, because many of you do not know Assumption University, I just give you just one sentence to remember by. That one sentence is, Assumption University is an ICU with the 3 E's. ICU here doesn't mean that intensive care unit of a hospital. It is an international Catholic and university with the 3 E's. The first E is ethics, because we are teaching ethics to the student. Number 2 is English, because we use English as the medium of instruction. And the third E is entrepreneurial spirit. So I repeat once again, Assumption University is an ICU with the 3 E's. With this, I wish you a kind of lively and dynamic exchange, engagement with our distinguished speakers for today on the startup valuation. So thank you very much for your attention.
Thank you very much, Reverend Brother Dr. Bancha Saenghiran, President of Assumption University. May I remind you again that our session will run from now until 5 p.m., so do stay with us till the end. And if possible, please don't get up and leave beforehand. Why? 2 reasons. The first is we don't want you to miss any juicy bit of insight from the speakers. And second, we don't want you to miss your chance of being one of the 50 lucky participants to receive a copy of this book. So, for those of you that stick around till the end, outside the door there will be a lucky draw for everyone to play your bets. All right, to begin, in this first session, we are delighted to have Mr. Douglas Abrams to talk about startup valuation and beyond, understanding VC term sheets. Mr. Douglas is the founder and CEO of Xpara and Xpara IDM Ventures, Singapore's leading incubator fund. He is also the managing director of Xpara Ventures Thailand, Xpara Vietnam, and Xpara Malaysia. He was the founding partner of Parallax Capital Management, a fund management company focused on real estate, private equity investment, and early-stage venture capital. Prior to coming to Singapore in the year 2000, he managed information technology at JP Morgan for 14 years. He was the global markets head of internet marketing and the VP and manager of investment banking technology. He is an adjunct associate professor at the National University of Singapore, or NUS Business School, and he has been a visiting professor in venture capital for the Sethjinda Graduate Institute of Business Administration at Chulalongkorn University since 2007. Now, without further ado, please let us welcome Mr. Douglas Abrams on the stage, please.
Okay, good afternoon, and thank you very much for the kind introduction. I'm really excited to be here at the Stock Exchange of Thailand to talk about startup valuation and beyond. I know we have a system for you to input your questions into online, and we'll be able to answer those questions later. But if you have any questions during the talk, please feel free also to ask those questions. I may ask some questions of you, and hopefully we'll get some responses, so we don't have to spend the whole of my session here, you just listening to me. Okay. I'll skip over this because I already had the complete introduction. This is the topics that I'm planned to cover today. So first I want to talk about what I call Welcome to Venture Capital World, because this is an introduction to venture capital mindset, without which it's sort of hard to understand about valuation and term sheets because lacking context. Then I'll talk about valuing startups and term sheet and deal structures. So without further ado, I want to start with this list, or these two lists. You can see on the two lists we have 5 companies. Can anybody tell me what this list shows? Like, what are these two lists? Oh, that was one of the question things I was talking about during my introduction, where I'm asking you a question. So anybody can just volunteer. Yeah. Correct. Okay, wait, give him a prize. Yeah. So these are the top 5 companies in the world in terms of value, but you see 2 different lists. What are the 2 different lists reflecting? The first list, so this list is the list on my right is the top 5 companies 10 years ago. The list on my left is the top 5 companies as of 2017. So what's the most obvious difference between those 2 lists relevant to our talk today? So yeah, we see the current list, it's all tech companies, and actually the only company that's on both lists is a tech company, which is Microsoft. And then what else about these 2 lists? What might jump out at you? If it's not obvious, okay, I'll tell you. The factor that unites all the companies on the current list is they were all funded by venture capital investors. So we see in the first list 10 years ago, only 1 company venture capital funded. On the current list, all companies venture capital funded. And I thought that was a pretty interesting reason that we're standing in a stock exchange talking about venture capital today. The world is changing. Of course, the world is always changing, but the rate of change is increasing. And the rate of change in creating the leading companies in the world is being driven by venture capital investment. And if I do this same exercise 10 years from now, do you think the list is going to look the same or different? Like, of the 5 companies that are on the list today, how many will be still on the list 10 years from now? It seems like, when we first think about it, we think probably all, but in fact, I bet not. I bet 10 years from now, this will be a very different list. Some of these companies will still be there, but there will be companies on this list that actually you probably never heard of today. Those are the companies that venture capital investors are investing in now. The companies that venture capital investors are investing in now are companies that we expect could be the leading companies in the world 10 years from today, or 15 years from today. So this is why venture capital is becoming more and more important for everybody involved in business to understand, and especially, of course, if you're in the startup ecosystem. I thought this was another interesting comparison. So if we look at the 3 most highly valued startups in the world, so the 3 most highly valued startups, meaning still private companies in the world today, are Uber, Airbnb, and Palantir. If we add up the valuation of those 3 startups, it's around 119 billion US dollars. On the other side of this list, I added up the market cap of the top 10 companies in Thailand in terms of their revenue, not valuation, but these are all publicly traded companies, and total valuation is 108 billion US. So the 3 most highly valued startups in the world right now have a market cap greater than the 10 top revenue producing companies in Thailand. This also is an interesting indication of the increasing importance of venture capital invested companies in the economy. And it also probably makes you think about, where do these valuations come from? How could it be the case that these 3 companies could be valued as highly or more highly than the 10 most revenue producing companies in Thailand? And this is going to be part of our topic for today. Now, I mentioned that the world is changing and changing quickly. And of course, this is something that happens all the time, but at certain points in time, we have more disruptive change than we previously had. So why are we in what seems like a very interesting time in exponential change in the economy? I think this is because we have reached a point that's highlighted in something called Amara's Law. Don't know if it's really a law, but the concept is that when new technologies come on the scene, they do affect transformational change, but in the short run, much less than we think, and in the long run, much greater than we think. Why? This is because technological change is exponential rather than linear, but we tend to predict most trends in a linear way. So we're now at 10 years since, 11 years now since the launch of iPhone. So the introduction of mobile computing has dramatically changed many aspects of the economy, and it really just became obvious in the last couple of years. So this is why things seem to be changing much faster now than they did maybe in the 10 years previous to that. Now, we were just having a discussion about this in our panel room before the talk. So Moore's Law, another driver of exponential change in our world and economy over the last, at least since the introduction of personal computing, but actually I have some view on Moore's Law actually in information processing, way predating digital computers and actually having the potential to continue well beyond current silicon-based computers. So this is another trend that's driving change in the market, the exponential growth of information processing technologies, which appears set to continue to increase exponentially over the next however long, driven by technologies like quantum computing. When I said things are different now, so how are things different now? And I like to look at the business and economy in what I call the corporate age. So corporate age is what we all sort of grew up in, and where institutions like Stock Exchange of Thailand develop. This was the world where people in business communicated on telephone. Products are physical. The dominant media is TV, radio, and print. Products were distributed by trucks and trains. Organizations were centralized. And business model was intermediated. Sustainable competitive advantage came from brand, and the environment was relatively stable. So if you go back to my list of the 5 most valuable companies in the world 10 years ago, and then look 20 years ago, 30 years ago, 40 years ago, there's not that much change. Now you see in the last 10 years, the entire list has changed, and I'm willing to make some prediction next 10 years it's going to change again. Why? Because environment is no longer stable for business. In the startup age, where we are now, the enabling communications tech is internet. Products are increasingly digital. Dominant media is social media. Distribution methods are downloads and drones. Organizational principle decentralized. Business model is disintermediation. Competitive advantage comes from network effects more than brand. And we live in an age of continuous disruption. So continuous disruption is what drives venture capital investment, because venture capital investors are looking to invest in the disruptors of the future. Now, talking about SME versus startup. So this is when we think about the changes in the economy and what types of companies VCs invest in. I always like to make a distinction between SME and startup, and this is especially important in Thailand because we have a lot of SMEs and we have a growing number of startups. So what's the difference between an SME and a startup? Both are small, so this creates a little confusion because a small company might be an SME or might be a startup. But the main distinction that I would draw between SME and startup is about the growth trajectory. So SMEs are small companies that are conceived and designed to grow slowly over long periods of time and to become profitable as quickly as possible and to return those profits to the owners who then can use the profit to live on. Startup companies are designed to grow rapidly over short periods of time, not necessarily, and in most cases don't generate early profits, but achieve scale as quickly as possible, so grow to a significant size over a relatively short period of time, and then generate returns for their shareholder owners through increasing firm value that results in a transaction where the company is either listed on an exchange like this or sold to another company. So we call that in venture capital scalability. Scalability means we look to invest in companies that are capable of reaching, okay, this number, it's not a law or a very strict number, but to give us a sense of scale, we look at companies capable of reaching $100 million in firm value within 5 to 10 years. And this enables the venture capital investor, if they're successful, to achieve something like a 30-time return, which I'll talk about in more detail in a minute. So, but I want you to keep this, this view of what a startup is, basically a company that's designed to become very big, very fast, and generate significant return to investors through capital gain. So the next most important factor that we need to consider in understanding venture capital valuation and, of course, even venture capital investment in general, the relationship between risk and return. So what is a relationship between risk and return? This one is really easy because the answer is on the slide. But, okay, I like to say this way. On the slide, I say risk and return are highly positively correlated, but I think the way we usually think about this is high risk, high return. Correct? Yeah? I would like everybody to say that now. Say it together with me. Are you ready? Say high risk, high return. Okay. Now we're thinking like venture capital investors. High risk, high return. And of course, the opposite of that is what? Oh, don't have to say it together. Yeah, it's okay. Low risk, low return. So high risk, high return, low risk, low return. And I think we all know this, but actually we don't really think about it in detail like venture capital investors do. High risk, high return, low risk, low return means that there are no low risk, high return investments. There are only low risk, low return investments and high risk, high return investments. Of course, also medium risk, medium return, and every gradation in between, but there are no investments that break this relationship between risk and return. Therefore, if we want to generate high return, we need to do what? Take high risk. And if we want to generate higher return than we are currently generating, we need to do what? We need to take more risk than we're currently taking. So every investor, including you, if you think about your own personal investment portfolio too, has to take one of two paths. Path one is become satisfied with current return and take no more risk. Path two is take more risk to potentially increase return. There's no third path. And actually, I notice it not just in Thailand, but pretty a lot in Thailand, people looking for like low risk, high return investment in like multi-level marketing or direct sale type of things, where these are what? These are high risk, low return. There are no shortcuts. There's no way to increase your return without increasing your risk. And all institutional investors know this, and therefore institutional investors look for investments where they can generate higher returns through taking higher risk. Why are there no low risk, high return investments? Because supply and demand. The return on investment is determined by supply and demand of capital, because the return is essentially the price of the investment, and all prices are set by supply and demand. If there are disconnects between risk and return in investments, they're very short-lived. Because why? Markets will erase them almost as soon as they become available. More capital will flow into any investment where the return is too high relative to the risk, which will drive down the return. Okay, so we want to increase our return. How do we do that? We need to take more risk. How can we take more risk? We can invest in what? Venture capital. Because venture capital is the highest risk, highest return investment in any traditional asset class, available asset class. So another way to think about venture capital is venture capital exists to provide an opportunity for investors who want to take higher risk to generate higher returns. Now, this seemingly simple idea has some very interesting consequences when we start looking at valuations of the companies that venture capital investors invest in. Example, okay, imagine you're a venture capital investor and a startup comes to pitch you and they say, okay, we have a great idea for a startup. This startup is guaranteed to not fail, guaranteed to succeed. It's a 100% assured chance of success. So, do you want to invest in that startup? No, you will definitely not invest in that startup. Why? The reason is, there's two reasons. One, if they're wrong, then they're diluted and you don't want to invest in them. If they're right, this startup will not generate high return. Because why? The high return that startups generate comes from the probability that they're going to fail. So now we have a second startup pitching us that says, I have a great business idea. It's the riskiest possible business that you could invest in. It's almost guaranteed to fail. Do you want to invest in that startup? Yes. So in venture capital investing, failure is good. And not failing is bad. So this is a different way that we have from looking at risk in our day-to-day life, but it's very important to internalize if we want to understand A, what venture capital investors do, and B, how do we value startups? So who are the players in this what I'm calling venture capital world? On the one side, we have entrepreneurs. Entrepreneurs are the people that create startup companies for investors to invest in. I have two categories of entrepreneurs here. One I call lifestyle entrepreneurs. These are basically entrepreneurs that are starting SMEs. So they're entrepreneurs that want to start a business to fund the lifestyle, which is a great thing to do, but it's not investable by venture capital investors. Second type of entrepreneur are the high-growth, scalable entrepreneurs. Entrepreneurs who are setting out to do a startup, as I defined before, and these are entrepreneurs who want to create a company that's going to grow very fast, achieve a significant firm value, and then enable investors to sell their shares at a very high return. So who are the investors that invest in these startups? Going from the bottom of my list to the top. So government. Government is a very important player in venture capital investing in every center of entrepreneurial and venture capital excellence in the world, including in the US, in Israel, in Singapore, and in Thailand. So government plays a very important role in funding especially early stage startups through a whole range of programs, sometimes direct investment, sometimes fund-to-fund programs, sometimes grant matching programs, or some combination of those. Banks also play a role in venture investment. Here I'm talking about traditional bank lending, although it's a pretty small percentage of funding at the early stage, corporate VCs and investors. So corporate VC or CVC, it's a very important category of venture capital globally and especially in Thailand. In Thailand, I think we have a very interesting situation where in other markets with thriving venture capital sectors, the financial venture capital sector has developed first and the corporate venture capital sector second. In Thailand, I think it's reversed. In Thailand, the corporate venture capital investors have actually led and are leading the growth of the VC sector here, with financial VCs sort of catching up. So I think this is a very exciting development, and it's going to be really interesting to see how it plays out and how it affects the ultimate development of the venture capital sector here. Now, what's the difference between a corporate VC and a financial VC? In the top row, I have VC, which I mean financial VC, and CVC. So the difference is, in a corporate VC, the source of funds, so the investors in a corporate VC are a company whose main business is not venture capital and who is usually investing in the CVC for both strategic and financial return. For a financial VC, the investors will be financial investors seeking only financial return. So we'll see this source of funds will have some important implications in the approach to A, valuing, and B, structuring deals between CVC and VC. Sometimes they overlap very nicely. Sometimes there's some divergence. For valuation purpose, I think the most important difference between CVC and financial VC is cost of capital. The CVC will have a cost of capital determined by the parent company. The financial VC will have a cost of capital determined by the investors in the venture capital fund. Angel investors. Angel investors are individuals who invest in startup companies. So I'll distinguish between a venture capital investor who is investing other people's money. Now, some venture capital investors, the managers of venture capital funds might have some of their own money in the fund, but the vast majority of the money invested by venture capital funds is other people's money, whereas angel investors are investing their own money. So this also has important consequences in deal structuring and valuation because, again, going back to cost of capital, if I'm an angel investor, my cost of capital is whatever I believe it to be. If I feel like I am satisfied with a 3x return on an early stage venture capital investment, that's my cost of capital. I can determine it myself. If I'm a venture capital investor, my cost of capital is determined by the investor in my fund's required return. Now, angel investors play a very important role in every startup and venture capital ecosystem because typically they invest at the earliest stage in startup companies. They also often provide hands-on support and mentoring for the companies they invest in. And in most economies with a developed venture capital sector, angels invest almost as much or as much as VC funds. Now, we definitely have a also thriving angel investment sector in Thailand. One of the things we talk about, one of the trends that I see and something that a lot of venture capital investors are concerned about is angels distorting valuations in Thai startup markets. So I'll talk a little bit later more about this, but we have seen a trend where angel investors have been overvaluing some startups in the market, which creates significant problems both for the startup and for the angel investor in the long run. So good thing about angel investors, they invest their own money, and as you might have got from what I just said, they might be a little more favorable on some terms like valuation, and they may have less restrictive terms in their investment agreements. The bad thing is, or one of the drawbacks of angel investors is, what type of qualification do you need to be an angel investor? Who certifies you as an angel investor? You. I mean, basically anybody can be an angel investor. So therefore, the quality of angel investors will vary a lot. For a venture capital investor, it's not like that. Now, venture capital investors, some are certified by government. If they're investing for a company, if they're a CVC, they've been certified by the parent company. If they're a financial VC, they've been certified by the investors that put money in their fund. Angel investor, investing their own money, basically anybody can be an angel investor. That can be a good thing or a bad thing. And we'll talk about that more later in the panel discussion. And VCs, so venture capital investors, which I already described, are financial investors investing other people's money. Because they're investing other people's money, they're subject to market forces in their valuation and return requirements. So therefore, they'll have much more standardization in their deal terms and valuations. So I'll use venture capital funds as the benchmark for most of the data that I'm going to be talking about next. Now, when you look at this list of companies, you can see a common thread that connects all these companies. Like, looking at this graphic, how would you say, in what way are all these companies the same, besides the fact that they were all invested by VCs? Is there anything that jumps out at you when you see this list? Like, how is Google the same as Starbucks? Or Apple the same as Home Depot? In what way are they all the same? Say again? So all or most at some point became public companies, but what else? How are they different from other public companies? Okay, you might say they're all US companies, which is true, but that's, I think, a sort of historical artifact because of the time that this study was done. Okay, I'll give you a hint. Like, let's say I name a product category and you tell me the first company that comes to mind. Search engine, Google. Coffee, Starbucks, and on down this list. Every one of these companies is or was the #1 company in their product category in their market, and for many of these companies, their market is the world. So this gives an interesting insight into, it helps to illustrate the task facing venture capital investors. Venture capital investors seek to invest in companies today that will become the #1 company in their product category in their market within 5 to 10 years. And this is a very daunting task. If you try to think about any interesting product category today and then predict what company will be #1 in that product category 10 years from now, you can see the challenge that venture capital investors face in choosing companies to invest in. Now, is it okay if we invest in companies that are #2 or #3 in their product category in their market 5 to 10 years from now? Probably not, because in our business, there's no second and third prize. There's only #1 and losers. So why does it work like that? We need to invest in companies that will generate very high returns because of our cost of capital, which I'm going to go into in more detail in a minute. But in order to generate those high returns, we need to be able to sell our shares in that company, either in a public listing or in a sale to another company, and we need to be able to do that within 5 to 10 years. And which companies typically make it to that endpoint are the companies that are #1 in their product category in their market. And the companies that generate the highest returns at those events are the companies that are #1 in their product categories in their markets. You can see right now in hot product categories, so like ride sharing. How many successful startups are there in ride sharing? Very few, right? There's Uber, and then in Southeast Asia, there's Grab. Actually, before there were two, right? Grab and Uber. Now Uber is gone, and left is only Grab. So if you're a venture capital investor investing in ride sharing, you better have invested in Grab. If you didn't, if you invested in some other ride-sharing company 5 years ago, you're not going to generate a return. The investors who invested in Grab are going to make a really nice return. And this is how our market works. So we have to pick those companies, and we have to pick them before anybody ever heard of them. Actually, I heard about Grab about 7 years ago, five years ago, before anybody else heard of it. Unfortunately, didn't invest. Oh well. But yeah, but that's what you have to do. You have to invest in Grab before anybody knows what it is. And then you have to think about the companies today that nobody's heard of that are going to be at that level within 5 to 10 years. So what does the startup company fundraising look like? Startup companies raise money through various stages. And this graphic illustrates what I call the VC process, venture capital process of startups raising money. Actually, the venture capital process that startups use to raise money and venture capital investors use to invest money is a tremendous innovation in finance itself. And if you look at the growth of high-growth, high-tech startups in an economy and the growth of venture capital in that economy, they almost always go hand in hand. Why? Because without this venture capital funding process, it's really difficult for high-potential startups to raise funding. What characterizes venture capital funding process and makes it different from traditional funding is that it is broken up into stages. So the startup begins with founders' capital. Then they raise their seed or angel round investments. Then if they're successful with seed or angel round investment, then they go to their Series A venture capital round. They invest the money they raise in Series A. If they're successful with Series A, then they go to Series B and so on through Series C, and then maybe D, E, or whatever. Go maybe several additional funding rounds and then exit. At any point in this process, and for most startups, they will drop out of this process before they get to exit. Why is this so important in funding startups? A typical startup, to get from founders' capital to exit, they need to raise a lot of money. Now, how much money will depend on what sector they're in, what their business is like. But let's just pick a typical like software business that wants to go from founders' capital to exit. I would say they will raise on average somewhere between $20 and $30 million. Now, imagine you're a startup founder and you need to raise even $20 million US. You go to talk to investors with your prototype, your MVP mobile app, and maybe a little initial traction, and you tell the investor, I need to raise $20 million for this product to get to exit. How large is the universe of investors willing to fund that? It's very small. If you could find one investor willing to do that, it would be amazing. Why? Very few investors are willing to invest at one shot $20 or $30 million into an unproven product. But the situation is even worse. Why? If the entrepreneur could find an investor that was willing to invest $20 million in their unproven idea, they wouldn't take the investment. Why wouldn't they take the investment? Because the investor would rationally require almost all the equity in the company for that investment. Assume that company had a reasonable, let's say $2 million, which is already a little high, but $2 million pre-money valuation for that company. Investor puts in 30 million, therefore they get 30 million divided by 32 million. So they get like 98% of the company, or 96% of the company. So in breaking the funding process up into stages, in enabling startups to raise small amounts of money and then increasing amounts of money at every stage, enabling the startups to invest that money in growing the company and increasing the valuation of the business, the venture capital process enables startups to raise money while giving up reasonable amounts of equity, and investors to take reasonable risk, high risk but reasonable risk, at each stage of the company's growth. One other point I'd like to make about this slide, you notice the first step in the venture capital funding process is labeled OM. OM means what? So every startup begins with funding from own money. Yeah, OM is own money. So we expect that every startup will have, a startup team will have invested some of their own money in the business. And why is that so important? There's only two types of money in the world, OM, and the other type is OPM. OPM is other people's money. So all startups and all funding is a combination of own money and other people's money. And the reason we want to see startups with having invested some of their own money, because how much more willing are you to spend other people's money than your own money? A lot. And startup founders too. So we want to make sure that there's responsibility in the way that the startups spend the money. Another very common source of early funding for startup companies is FF&F, which is friends, family, and fools. Yeah. So why do we say that? Because we like to see if that the startup has raised money from friends and family, because that shows that the people that know this startup or the entrepreneurs the best are willing to put some money into the company. We think that people that are not friends and family that invest at the same stage on the basis of relationship may be taking even too high of a risk for us, so we call fools. And how do VCs make money at the end of this process? I already alluded to this, but VCs make money through exits. Exits mean that the startup is sold to another company, usually a larger company in the same or adjacent sector, or the startup lists on a public exchange like Stock Exchange of Thailand. And for VCs, no exit equals no returns. So sometimes one of the questions I like to ask entrepreneurs when we meet in the first talk, first pitch is, so what's your exit strategy? And sometimes the entrepreneurs will say, oh, we don't have an exit strategy. Or it's too soon to think about exit strategy. And for me, I feel like, oh, so actually there's no return therefore on this investment, so why are we even talking? So it's very important for entrepreneurs to think about exit strategy at the same time they go out to raise money. Because if you tell an investor you don't have an exit strategy, that's the same thing as saying, I want money from you and will never deliver a return. Does that sound interesting? I don't think so. Now, I think that question may get a little misunderstood when entrepreneurs hear, what's your exit strategy? They hear me saying, like, are you going to quickly sell this business? But that's not the question. The question about exit strategy is, when are you going to sell? You know, to whom and for how much? And you're going to see in a minute that actually this is the most important question in valuing startups. So let's look at that in a little more detail. Okay, before I get to the valuation methods, I want to introduce the concept of most traditional valuation methods fail when we try to apply them to startups. Now, why do they fail? Most traditional valuation methods are designed for publicly traded companies because most of the valuation exercises that, for example, we do in investment banks are for publicly traded companies. And these companies create values for shareholders two ways, through capital appreciation and dividends. And the valuation methods therefore attempt to value the company from the perspective of a shareholder, looking at the potential for capital appreciation and dividends. Startups create value for investors only one way, through exit. And these exits are either trade sales or IPO. Therefore, effective valuation method for venture capital investors will reflect the real value to investors, meaning how much is this company worth to me if I invest today and the company is sold within 5 to 10 years in a trade sale or an IPO. So looking at these traditional valuation methods, PE method. So PE method of valuation values companies based on earnings, and it assumes that the value of the company should be some multiple of earnings depending on the growth prospects of those earnings. So if the company has high growth prospects of earning, we'll value highly, and if not, more lowly. But it doesn't make sense for startups. Why? Because startups will highly prioritize revenue or growth over earnings. There's a conflict between maximizing my earnings and maximizing my growth. Why? Because money that's left over for earnings at the end of each year was money that could have been reinvested in growth of that company for next year. So many startups seek not to maximize earnings in the early years. They seek to maximize growth. Why are they maximizing growth? Because they want to get to the highest possible firm valuation for the exit. So, one question that I hear a lot about valuation, people will look at the Uber valuation I showed in previous slide, 68 billion, and say, this company is losing money every quarter. It's ludicrous it has valuation 68 billion because they're losing money. Now, we can argue about whether that's a fair valuation or not, but not on that basis, because I'm not privy to Uber's real business plan, but I'm pretty sure they're not trying to maximize earning. Why? They're trying to maximize growth so that they own the ride-sharing market, so that when they go IPO or trade sale, in their case most likely IPO, they get the highest possible valuation. So valuing companies, startup companies on the basis of earnings won't work. It'll give a meaningless result. Same thing with dividend yield, because startups don't pay dividends. Same thing with multiples of book value, because multiples of book value value companies as liquidation value, not growth. Now, comparables valuation we can use for startups. I like to use a modified form of comparables valuation, which I call comparable by stage. What does that mean? In comparables valuation, traditionally we try to find a reference company or group of reference companies with known valuations, and then we can adjust our target company's valuation based on differences between the reference company and a target company. For startups, it's going to be very difficult to do it that way because most of the reference companies don't have known valuations, because most of our transactions take place in private markets, and adjusting for differences is also going to be difficult because we'll have a lack of financial ratios to use. So I think we can still use the comparable concept by applying it in a different way, which I call comparable by stage. That's very simple valuation method. And we were talking about this before the event today, that a lot of VCs use a variation on this. So how does it work? Comparable by stage. All we need to know about your startup to value it is, what stage of investment are you at? If you're seed stage, your valuation is probably between 1 and 3 million US dollars. If you're a seed stage startup in Thailand right now, your valuation is probably somewhere between 1 and 3 million dollars. That's it, very simple. If you're pre-seed, the valuation is lower. If you're a post-seed or pre-series A, valuation will be a little higher. So we will just value each startup at the average valuation for their stage of development. Now, of course, a lot of startups don't like this approach. Or startups will object to this approach by saying, but my valuation should be higher than average for my stage because my startup is better than average. But is that true or false? It's false. Why is it false? Like, what percentage of startups believe that they're better than average for their stage? 100%. But how many can actually be better than average? Only 50%. And 50% must be worse than average. So the only realistic way to value startups is average. So comparable uses average by stage. Next is discounted cash flow. So discounted cash flow, it's also very difficult to use for startups because why? First of all, it's hard to do too good projections for startup cash flows. But second is, startup financial model is not necessarily based on maximizing cash flow, because cash flow comes below earnings, and I mentioned earlier, we're not trying to maximize earning. So we use some modified version of discounted cash flow just because investors are used to seeing it, but it's very difficult to get a good valuation from discounting cash flow for startups. One of the ways that we modify typical discounted cash flow valuation method to apply to startups is increasing the discount rate. We use a discount rate of between 100 and 130%. But even then, it's still going to probably not give a satisfying result because it assumes a financial plan generating a lot of cash flow. So where does this leave us? This leaves us with my favorite valuation method, which I'm going to talk about more now in detail, which is called, appropriately enough, the VC method of valuation. This is probably, if you have heard of the other valuation methods, this is probably the one you haven't heard about, because why? It's only typically used by venture capital investors to value startups. So this is a formula for venture capital method of valuation, but I'm trying to eliminate all formulas from our workshop, so we won't talk about this. But in case you want to work through at home, you can use this to do real VC method valuation for your startup. This is my simple explanation of VC method. This is how VC method works to value your startup. We know that VC, from earlier discussion today, we know that the VC's return is dependent on the exit valuation. So actually, I can do very quick calculation of my return on any investment. I can just say, okay, how much, what will the value of this company be at exit? And then I can just say, how much, what valuation are we investing at now? So example, let's say this company will be sold for $100 million. The current valuation is $2 million. So what will my return be? If the company will sell for $100 million, my current valuation is $2 million. My return will therefore be 50x, 50 times. Why? The company is worth $2 million today. We sell for $100 million. 100 divided by 2 is 50. If the valuation today is $3 million and we sell for the same $100 million, my return will be 33 times, because 100 divided by 3, it's 33.3. So this is getting us very close to valuation, right? Because we can now use this exact same approach by starting with the exit valuation of the company, using my required return will give me current valuation. If exit valuation divided by current valuation gives me return, then I can use that exact same formula by setting my required return at a certain level. Now, luckily, we know this level. We know that at seed stage, VC's required return should be 30x, meaning we should get $30 for every dollar that we invest. Now, I'll explain where that number comes from in a minute. If we need to get $30 for every dollar we invest, then what is the valuation of your company if it's $100 million exit? So imagine the company will exit for $100 million, and I need to get 30x. This means current valuation should be $3.3 million, right? But this misses one important adjustment we need to make in this formula, which is dilution. If the current valuation is $3 million and I sell for $100 million, I will only get 33x if I am not diluted between now and exit. Now, dilution means what? Normally, when we invest in companies, we invest for equity. So we invest in the company, we get equity in the company. The equity that we get comprises a certain percentage of the total equity. So if we invest $1 million in a company that's valued at $3 million, we get 33%. If new investors come in after us, we will be diluted because the company will issue new shares to those investors and our share will go down. So in order to adjust our VC method valuation formula for dilution, we have to increase the required return. Now, at seed stage, it's likely that I will be diluted by 50% between investment and exit. I'll show where that comes from in a minute. But assuming that's the case, I will be diluted 50% between investment and exit. Therefore, in order to get 30x return, my current valuation equals exit valuation, divide by 60. And this is the rough rule of thumb that I like to use to value seed stage startups. If you will exit for 100 million, your current valuation is 1.67. There you go. So that's, you came to hear, right? How we value startups. Now we know. Yeah. And every VC is doing some variation of this method, whether they're using this exact formula or not, but this is how VCs think about valuing startups. And this is, unfortunately, not how most startups think of valuing themselves. How do most startups think of valuing themselves? Like the most common way, like when I ask startups, like, how did you derive your valuation? The startup will say, I heard about another company that got this valuation. You know, my friend's company got the same valuation, which is like totally meaningless to me, right? As an investor, why do we care what a friend's company got? Now that we could go back to comparables if you want to talk about that, but I can tell you if your friend's valuation is very different from stage comparable, there was something wrong with that investment, meaning what? They probably got from an angel investor. And then another way startups value their company is say, in the last round we were valued this much. But again, it doesn't matter because what your last round valuation was, it's irrelevant to the current investor. What's relevant to the current investor is, can they generate required return? And in order for an investment to be successful, it has to do what? It has to return more than cost of capital. If an investment returns less than cost of capital, it's a fail. And this is a concept that, again, in venture capital, it's a little mind-boggling, right? Because sometimes I'll tell startups, like, okay, the startup is talking to us about, for example, 5x return. You will get a 5x return on this investment. That's 500%. And I tell the startup, oh, that means we're losing money. So how can you be getting 500% return on investment and losing money? The reason is our cost of capital is way higher than that. Therefore, we have effectively lost money on that investment because the return is less than our cost of capital. Now, where does our cost of capital come from? Our cost of capital comes from our investors' required return. Investors' required return in venture capital fund, okay, here I use a very round number of 20%. So just to make the math easy, for a typical venture capital fund investor, they want minimum of 20% investment per year for 10 years. 20% return per year for 10 years across the whole fund. This means the entire fund needs to grow 6 times over that 10 years. Now you might think, okay, therefore our cost of capital for investment should be 20% per investment and we can get a 20% return on investment. It's not correct. Because why? Only 20% of our investments will exit, and this is generous. In real life, a lot of those exits are going to be exits at multiples below cost of capital anyway. But let's just give you the benefit of the doubt for a minute. So we'll value your startup assuming 20% of our investments will exit. In order to generate a 6x return on the total portfolio over 10 years, we need our 20% of exits to grow 600%, which means each of those successful exits must deliver 30x return. That's where the 30x comes from. Now, this is a little more clearly illustrated in this chart. So you can see, okay, why do we need 30x return per investment? If 100% of our investment succeeded, we could generate a 6x on the fund with each investment generating 6x. But in order for us to generate 30x on the fund with only, in order for us to generate a 6x on the fund with only 20% of our investment succeeding, each successful investment has to generate 30x return. So this very high required return, it's not because VCs are greedy. Like, let's say sometimes when I go through this math with startups, they feel unhappy or get, very resentful. Like, why should it be like this? And they want to blame me, right? But I say, don't blame me. Who should you blame? You should blame all your other startup friends who are failing. in real life, we shouldn't blame anybody. It's not anybody's fault, and there's nothing wrong with this. This is not a bug in venture capital. This is a feature. The feature in venture capital is venture capital fund investors want high returns. That's why they put money into venture capital funds. We invest in a diversified portfolio of startups knowing that most of them will fail because why? Then the ones that succeed will generate very high returns. So it's actually a virtuous cycle. Where these numbers come from, I talked about already, but investors in venture capital funds set the cost of capital. So if you want to get mad at anybody, you could get mad at the investors in our fund that require that 20% return. But they're also not doing anything wrong. Why? Because they're requiring a rational return for the risk that they're taking. And in fact, if they didn't get these high return, they wouldn't put money in the fund. So, one question I get is sometimes, especially from policymakers, is how can we reduce startup failure rates? But actually, we don't want to reduce startup failure rates. If startup failure rates reduced, returns on startup investment would reduce, and the interest of venture capital and fund investors to put money into VC would go away. So one way to think about that is, if all startups succeeded, they would all return like 3%, and therefore nobody would put money into startups. They would just invest in government bonds. So, okay. Other important influences on our valuation numbers. VC portfolio returns are not normally distributed. I'm going to show a slide on that in a second. Most VC-invested startups fail to return capital, so the small number of winners must pay for all the losers, and VC holdings will be diluted. So this is a look at the high returns required by fund investors that I talked about. So you can see that the mean cost of capital for venture capital funds is 16%, and top quartile is 25%. Venture capital fund investors all look at this chart, and therefore they all want 25% because they all want to invest in top quartile funds. This means what? Fund managers that don't meet these returns will disappear because they won't raise the next fund. If you fail to return the required return to investors in Fund 1, you never raise Fund 2. So in the long run, there will only be venture capital funds in the market requiring these returns. Now, this is a point that I alluded to in previous slide that I want you to really think about, because this is, I think, the very illuminating chart when you think about venture capital investment. And one of the reasons why valuations and actually the fundamental reason why venture capital valuations are so much different from other fund or investment valuations we're used to seeing. Most investment returns are normally distributed. They follow a bell curve like the one that you see on this chart. What does it mean? It means when let's say we select an investment at random from your public equities portfolio. What is the most likely return? The most likely return is the mean in the distribution. So it's the middle of my bell curve. And then we know that on average, 2/3 of our investments will return within 1 standard deviation of the mean, and 95% will return within 2 standard deviations of the mean. And that's how we're used to thinking about investment returns and therefore value of the companies we invest in. But venture capital portfolio returns are not normally distributed. They are distributed according to a power law. That's the other shape that you see on this chart. Power law is the line that goes like this. So what does it mean? It means that a very small percentage of the portfolio will drive all the returns. All the other investments in the portfolio will fail to deliver either any return or meaningful return. And that means what? So the most likely return on your investment in a startup is what? 0. When we're a venture capital fund and we invest in a startup, the most likely return on that investment is 0, and 0 doesn't mean we get back the capital. 0 means we lose the entire investment. And to put this in perspective, in a typical venture capital fund will make between 20 and 70 investments. How many will succeed? Between 1 and 4. So 1 to 4 investments will drive all the returns in almost all successful venture capital funds. Okay, then this is what power law looks like in real life. So this is a study of something like 17,000 venture capital investments. This is the same thing in a pie chart. So it's very easy to see here. We look at, here we're looking at first non-seed investment. So this is like post-seed or pre-series A. You can see that in a very large sample, 17,000 investment sample of venture capital fund investments, over a 10-year period, we saw 74% of the investments failed to return capital, meaning they returned either 0 or less than 1 time. And another 12% returned only 1 to 5 times, which is way below cost. Another 14% returned 1 to 5 times, which is way less than cost of capital. And you see that very small sliver at the top, which is 3%. These are the ones that drove all the returns. These are the ones that delivered 20x or more. Remember, 20x are 30x is really our number. So here, included in 20x or more are the 30x. But this is the distribution of returns we face as a venture capital fund. And this is what all startups need to think about when they calculate their valuation. The most likely value for your company in the future is 0. There's a very small chance that you're going to be worth a lot, and that's how we need to value your company. Surprisingly, these failure rates don't reduce that much through Series B. I don't have data for Series C and D, but we still see more than half and in close to 2/3 of portfolios delivering less than 1-time return, even through Series B. This is an illustration of the dilution that I talked about before. I mentioned that a typical seed stage investment would be diluted by 50% between investment and exit, and here's how it happens. A seed investor starting with 20%, the company went through 4 rounds of funding, Series A, B, C, and D, before exit. This is not uncommon. A lot of startups would go through 4 or even more stages of funding, and if each investor post-seed got 15%, which again is pretty conservative assumption, by exit, this seed investor would have only 10% left. And dilution, however, is not bad. So sometimes startups worry or entrepreneurs worry that dilution is bad. Actually, normal dilution is good, meaning dilution in which the investor is diluted because a new investor comes in at a higher price than we paid. It's good because it's expected, and this is how companies raise more money. The only type of dilution that's bad is excessive dilution, meaning a situation where the startup raises money in a future round at less than we paid, and that is something we may be protected against in investment terms, especially if the initial valuation was too high. This is another model looking at model venture capital fund and making a reasonable number of investments. And I won't go through all the details of this. If you have questions about it, let me know. But you can see here that when we go through this calculation, each startup still needs to return 31 times in order for the fund to be successful. Now, talk about exit. So, should the startup exit in a trade sale or IPO? I'm sorry, stock exchange, because we're here, and definitely stock exchange is a great exit for startups if they can get it. But in real life, most venture-funded startups exit in trade sales. 90% of venture capital funded exits are in trade sales. Why? Because there are many more trade sales every year than IPO. There are at least 10 times more trade sales every year than IPOs. So most startups will target trade sale as an initial exit strategy. The reason 2017 bar is so small here, it's a half a year. But you can see the proportion is the same. And median value of exit venture-funded startups at acquisition is $100 million US in 2017. So this is where I got my 100 million number. Now, this is looking at US startups. I believe US startups probably sell at higher valuations than Southeast Asia. But for Southeast Asia, we're looking 5 years in the future. So I think probably washes out. And this is looking at median value of exits, trade sale versus IPOs on local exchanges. You can see trade sale, it's like right in the middle of local exchange. This is how VC method works in the spreadsheet, and you can see again my 1.66 number, which is probably pretty reasonable valuation for many local seed stage companies. All right, so valuation is our first most important topic, but now I want to talk about term sheet and deal structure. So, key elements of venture capital deals. Venture capital deal key elements fall into two categories. All key elements of venture capital deals will relate either to the economics of the deal or control. Economics or control. So what does it mean? Economic terms determine how the economic fruits of this company will be shared between existing shareholders and investors if the company is successful. Control terms refer to what degree and type of control will investors have over the company after the investment. Now, important to note on this slide, you can see on the economics column, there are many deal terms. One pretty common mistake I see a lot of local startups make. They way over focus on valuation. Now, of course, valuation is a really important term, but oftentimes the startup will over-focus on valuation, ignoring other really important terms in the deal, where those terms might have a much bigger economic impact on the startup than valuation. I'll give an example. Okay, you can see my liquidation preference is the most important economic term after valuation. So I was talking recently to a local startup, and they were negotiating between two investors a $200,000 difference in valuation. $200,000 on a $5 million valuation, which is very small. And I calculated, like, in the case where this company went to 100 million, the value of that difference in valuation, 200,000, would equate to maybe $600,000. And they were ignoring a 2x liquidation preference, which would have cost them about $3 million, even ignoring the problem with future liquidation preference. So that's why I want to go through these terms now. Now, of course, actually, to understand all these terms in detail, it takes a really long time. So I'm just going to introduce each of the key terms and tell you a couple of things to think about. If you're interested to learn more about this, also you can let me know, and I can refer you to resources that have a lot more detail. Because before you do a venture capital deal or sign a venture capital agreement, which will include all these terms and maybe more, as an entrepreneur, you should really understand in depth what these mean to you. And of course, if you're an investor considering an investment in a venture capital deal, you should understand how all these terms work, what are the parameters for these terms, and how you should reflect them in your deals. So, okay, valuation and amount of financing. We talked a lot about valuation already. I want to make a quick mention here about preference shares. So, traditionally, venture capital investors always invest in preference shares, not ordinary shares. Now, in Thailand, this is a little less clear. In Thailand, the distinction between preference shares and ordinary shares is different than, let's say, in the Singapore or the US. So, in Thailand, some venture capital investors do ordinary shares, some do preference shares. You might encounter both in the market here. When Thai venture capital investors use ordinary shares, they still require rights that are usually assigned to normal venture capital preference shares. So that this will be relevant whether your share structure is preference or ordinary. Now you notice I mentioned already the first economic deal term that I want to talk about in a little more detail after valuation is liquidation preference, because liquidation preference is probably the economic term that has the biggest impact on the sharing of the fruits of this company at an exit, and some cases even more than valuation. How does liquidation preference work? I have a slide on that because it's a little complicated. Now, normally, when an investor is a shareholder in your company, let's say they just invest in ordinary shares with no liquidation preference. Then, when we sell the company, the proceeds of the sale would be shared what we call pro rata. Pro rata just means in proportion to our respective shareholding. Example, if we invested in your company and we had 20% and you had 80%, and just assume for simplicity's sake that that shareholding was unchanged at exit, and we sold the company for $100 million, I would get 20 and you would get 80. That's called pro rata. But liquidation preference changes that distribution. Liquidation preference has at least two important parameters that we have to look at. One is the multiplier. So in this example, I use what's called a 1x liquidation preference. 1x means when the company is sold before we distribute the proceeds, or at the same time we distribute the proceeds, the investor will get back 1 time their original investment. So example, let's say the investor invested $1 million. And we sold the same company for $100 million. The investor had 20% and you had 80%. Now, instead of you getting 80 and them getting 20, if the investor had a participating 1x liquidation preference, which you can see on my right here, they would get $1 million back first, and then the remaining $99 million would be shared 80-20. That's called 1x participating liquidation preference. If they had a 1x non-participating liquidation preference, they would, investors would have the option to choose between either getting back their original investment or their pro rata share. So in this case, the investor would choose either 1 million or 20% of 100 million. In this case, they would choose 20% and they would get back 20 million. If the company was sold at a very low valuation, so let's say the investor had 20% and the company was sold at 4 million, this would give them either 800,000 or 1 million, so they would take 1 million in a non-participating 1x liquidation preference. So basically, liquidation preference changes, we call the payout waterfall, meaning who gets paid what when we sell the company. Now, a lot of investors will want liquidation preference. Why do they want liquidation preference? Because it changes the payout structure in their favor, especially in the case where the company is too highly valued. So there is a very close relationship between liquidation preference and valuation. In what way? Let's say, basically liquidation preference ensures me to a certain degree that if the company is sold, I will at least get back my investment. Why would I be concerned about that? I would be concerned about that if I think the company is going to sell for a lot less than the entrepreneur thinks it's going to sell for. So in my first example, where I invested 20% and the company sold for 100 million, actually I don't care about liquidation preference anymore, but in the case where the company sold for 4 million, that means my original valuation, which was 5 million, was too high. So liquidation preference is a form of valuation insurance. The higher your valuation, the more stringent liquidation preference investors are probably going to want. The lower your valuation, the less stringent they should be on liquidation preference. So this is something I think entrepreneurs don't always realize, that liquidation preference and valuation are intrinsically linked. And definitely when your valuation is too high, investors are going to want very high liquidation preference or participating liquidation preference. Now, you have to watch out for liquidation preference. Why? One is the obvious reason, it changes the payout for this investor, but two is less obvious, but really important. It's something called stacking investment terms, or in this case, stacking liquidation preferences. What does that mean? Every investor that comes in to your company in subsequent funding rounds will require the same or better terms as existing investors. No new investor will come in at inferior terms to existing investors. Now, why do they do that? Because they're new money. So new money will always say, we want as good or better terms as old money, or we're not going to invest. So this means, for example, if you give the first investor 1x participating liquidation preference, all subsequent investors will also have at least 1x participating liquidation preference. And if you raise that $20 or $30 million that I talked about before, and that 20 or 30 million has 1x participating liquidation preference attached, this can reduce your return at the exit by something like 30% or more. How does that work? Let's say we sell for 100 million and I have 1x on 30 million participating liquidation preference. This means first my investors get 70 million and get 30 million, leaving me with 70. So you get your percentage based on 70, which that's what I was saying before. It's a huge hit to you versus a few percentage points of valuation today. So yeah, I would pay close attention to that. Vesting. So this is another very important term in investment agreements and something that founders don't always understand. How does this work? Founder vesting means that when we invest in the company, we expect that the founders are going to stay with the company until exit. And we expect this for whose benefit? It's to some degree for our benefit, but it's basically for the benefit of the other founders. Imagine you have a startup team with 4 founders, and each founder has 25%. An investor comes in and gets 20%, and each founder is left with 20%. And then a few months after we invest, one of the founders with 20% leaves the company. And assume there was no founder vesting for that founder. Now, what happens to their equity when they leave? It leaves with them. They take it with them because it's an asset, they own it. And the fact that they're no longer working at this company doesn't mean anything. So they take their 20% out the door. The remaining management team now only has 60% of the shares. The remaining 20% is with the inactive founder. So now what? Now you know what? We have to replace that founder. Maybe let's imagine they were CTO. Now we need a new CTO, and the new CTO also wants 20%. Where does that 20% going to come from? It likely comes from all the shareholders, but still, now founders are diluted a lot. And in the long run, this is going to hurt founding team terribly. The resentment of the remaining founders toward the founder who left and has the inactive shareholding just grows and grows over time. And we might even lose future rounds of investment if too much equity is held by non-active founders. So later we're going to have to try to get it back, and it's going to be hard to do that. Founder vesting removes this whole problem. So founder vesting says, typical case, each of the founders earns their equity over, for example, 4 years. So in the case I mentioned before, where a founder is supposed to have 20%, they will earn that 20% over 4 years, 5% a year. So each founder that stays for 1 year will have 5%. If they stay 2 years, they'll have 10%, and so on. After 4 years, they'll all be fully vested. So what I always tell the founding team is, this is in some way good for us, but really it's good for you. It's good because it keeps your founder team from fracturing when somebody leaves, and it keeps you from getting tremendously diluted when we have to replace management team members. And you know what? Actually, are you going to leave? I mean, if you're not going to leave in the next 4 years, this doesn't affect you at all. And since you're not going to leave, the only person this affects is the other founder who's going to leave. And should you be worried about that? Yeah, you should be worried about that. Now, why do people leave? People leave because they're bad people who don't live up to their responsibility? No, people leave for lots of good reasons, but that leaves the remaining team in tremendous difficulty. Now, if the founding team has put in significant time and money into the company before we invest, then they might get some shares pre-vested, because it could be the case that if they have to leave, for example, within the first year, they should still get some equity on the way out. But basically, your equity as a founding team, it's your most important asset, and you don't want it walking out the door with people that, for example, are taking $1 million a year jobs at Google in Mountain View and then taking your shares with them. Option pool. So, oh, by the way, founder vesting and option pool, we can't implement directly as a normal investment term in Thailand because of some restrictions on these, but we have custom design structures that mirror the effects of normal option pools and vesting already developed. So option pool is also very important for startups to designate a certain percentage of total equity in the company to be used to incent future hires. So when you're building a successful startup, you're going to have to hire a lot of people in the future, and some of these people may be management team members or key employees, and you're not going to have a lot of cash to pay. So how do startups create successful teams without paying market salaries? They offer options or equity participation to key employees. The option pool means that we upfront will determine how much equity can be allocated by the management team without getting shareholder approval. So this is another term that's actually really good for management team. Why? The option pool gives the management team the flexibility to issue up to the maximum amount of options without requiring shareholder approval. So for the CEO, this is a great tool for hiring. It means they don't have to go back to shareholders every time they want to hire a new key employee and give them options because they have pre-authorization to do that. Important variations in the option pool are how much to allocate, and also is this done pre-money or post-money? So does the dilution from the option pool affect only management team or management team and investor? Only existing shareholders or existing shareholders and investor? Anti-dilution is another clause that's closely linked to valuation. Why? Anti-dilution does not protect investors from normal dilution because investors shouldn't want to be protected from normal dilution. Any investor that asks you, like, as a startup, we should be fully protected from dilution, something is very wrong, and you shouldn't consider investment from that person or that company. Anti-dilution only affects investors from excessive dilution, which I defined before as investment in subsequent rounds at lower price than we paid for our shares. And again, if valuation is high, we're going to be much more worried about anti-dilution. If valuation is reasonable, we're much less worried about anti-dilution. Pay-to-play is a companion clause to anti-dilution where investors requiring anti-dilution will often give companies a pay-to-play assurance, which means that they are required to participate in future funding rounds, including down rounds, where the excessive dilution takes place. Otherwise, investors could lose some of their preferred share rights. So those are our economic terms. On the control side, VC investors will exercise most of their control through two mechanisms. One is a seat on the board of directors, and this seat usually comes with, or almost always will come with, special voting rights. How does that work? We will set up a list of what we call reserve matters, and in order for the board to pass reserve matters, the investor director must vote in favor. Items on reserve matter lists typically are things like hiring and firing senior management, doing investments outside of the normal course of business, the company taking loans or giving loans, the company merging with another company or buying another company. So typically, any action that the company or the board of directors might take that directly affects the value of the investor's shares will find its way onto this reserve matter list. Protective provisions are the same type of carve-out, meaning special votes required for the shareholders to pass certain resolutions or actions that directly affect the value of the investor's shares will require the affirmative vote of the investor shareholder. And really important for these reserve matters and protective provisions is to make sure you understand each of them and make sure the list is not too extensive. So some investors will have too many reserve matters or protective provisions. make sure you understand each of these and how they're going to affect the company's freedom to operate in the future. Drag-along agreement is a term in the investment agreement that enables the investor to force a sale of the company in the future in the case where the company has not sold. So let's say 4 years from now, no exit, then investor with a drag-along agreement can institute an exit, and all the other shareholders have pre-agreed to sell alongside them. And conversion is only required in the case where the investor had preference shares. This gives the investor with preference shares the right to convert to ordinary shares. Again, this is a little more complex in Thailand than in other country regulation, but still can be implemented, although the time to conversion is a little bit longer. Okay, so we talked about key deal terms and liquidation preference. My last topic before we go to panel discussion is cap table. So oftentimes investors will ask you, we ask in very early meetings, what's your cap table look like? Cap table is some sort of chart like this that shows the existing shareholding, current shareholding of the company before investment, and what the shareholding of the company will look like after investment. And one problem that so this cap table is called clean cap table. You can see this cap table is clean because it's got just the founding team, the ESOP, and a previous angel investor with a very small stake. One problem we encounter pretty regularly with Thai startups is something we call messy cap table. Messy cap table means cap table that's not clean like this. What do messy cap tables look like? Some things that come up with messy cap tables. We have an angel investor. Instead of 4%, they have 40%. So angel investors with 40% mean the company can never raise another round of funding because the angel investor has too much equity, and the next round investor wants to see most of the equity with the active management team. Another messy cap table item that we see a lot is a high-profile advisor has 40%. This is another obstacle to the company raising next round for the exact same principle. The new investor wants to see management team with most of the equity in the company because we know they're going to be diluted many times in the future. Another messy cap table item is something you don't see, which is there are people that have either shares in the company or should have shares in the company or have made a loan to the company that are not reflected in the cap table. This could have been some informal arrangement, maybe even with family members. This all has to get cleaned up before investment. Example, we meet the founder, their parents, invested some money in this company. That's great. It's friends and family. We love that. But they're not in the cap table. How come they're not in the cap table? Because they don't have any shares yet. Why don't they have any shares yet? Because they're not in the shareholder agreement. Why are they not in a shareholder agreement? Because we're, related. Which is okay, up until this point, but that needs to get cleaned up now. Either they have to get in the cap table, shareholder agreement, or they transfer their shares to founder, et cetera. So anything that's not like this, management team, previous round investors, and maybe an ESOP, if you have it set up, we're going to have to clean up before the investment. Now, why do we care about this? One is, of course, best practice, but two is, if we don't clean up now, the next round investor is going to clean up, or they're not going to come in. So either the company won't be able to raise money after our round, which is bad for us and bad for you, or they're going to force a cleanup, which is going to be even more painful in the next round. So messy cap table issues they're like a toothache. It's much better fix it now than later. If you wait till later, it's just going to be more painful. Okay, so that's my last topic for my presentation portion of the session. Now we're going to move to the next phase, which is Q&A. So.
All right. Thank you, Douglas. Right now, we have time for maybe one or two questions from the audience. I have in my hand here a very long list, Douglas, of the questions they have for you. I'm just going to pick maybe the top two with the most votes. So First question for you is, how involved does the VC get with the management or the board of the company which they have invested in? And are VCs comfortable trusting founders to pivot when necessary or deviate from their original plan?
So the first question was about how involved do the investors get in the management and board of the company?
Exactly.
And second question was, do VCs trust founders to pivot, right? So, okay, yeah, I always feel like definitely we're going to have a seat on the board of the company, and we're going to attend all the board meetings, and we're going to be available to help the company. But I think good VC investor should not be deeply involved in management of the company. So definitely we should be fulfilling our requirements as a board member and as an advisor and mentor for the company if they want help, but we shouldn't be managing the company. I always feel like if the VC has to manage the company, something is very wrong, because we're supposed to be investing in management teams that can grow these companies. If we have to be management team, then something has gone way off the rails. And then second question was about the pivot. Do the VC trust the startup pivot? In fact, most startups pivot. Pivoting as a startup, it's not a bad thing. Most startups pivot, and some startups will pivot many times. So definitely we would expect that the management team would pivot if the initial direction is not working. So whether we trust the startup to pivot, definitely we wouldn't invest in the company unless we trusted the management team to execute on a business plan, and the pivot will be an important part of the business plan.
All right, great. Moving on to the second runner-up question, how do you actually calculate the exit valuation? Could you explain on that a bit
how to
further?
calculate exit valuation. Yeah, so this is a really good question. So for me, I start, just like with the comparables valuation, I start with the average exit valuation. So I'll ask you, like, what is your exit strategy? If exit strategy is trade sale, then we know the average value trade sale is around 100 million US. Now, there might be some reasons why your exit valuation should be a little higher or lower than that, but you're going to have to talk about that. If you believe that your trade sale is going to be way more than 100, then you should be able to demonstrate with comparables. Like, okay, in our industry, there's some recent trade sales where the companies are selling at this multiple of revenue or this multiple of users, and we expect that trend's going to continue over the next few years, and therefore we're going to get $150 million or $200 million exit valuation. If you're planning to exit in a listing, then when we would look at what's the average, IPO size for a company like yours. So we look at comparable exits, average exits, and comparable exits, and we'll derive the exit valuation from that. Now, you can't just, it doesn't extend to you being able to say, so Facebook had $65 billion IPO, we're just like Facebook, so we're gonna have $65 billion exit. Because why? That's a freakish outlier in exit distribution. So I would start with the average, and then we'll look at up or down from the average based on specific examples of exits, companies like yours.
All right, great. I know there are a lot of questions from the audience. I really do apologize we couldn't cover them all, but do get in touch with Douglas after the seminar if you want to ask anything else.
Please feel free, send other questions or anything you want to talk about. Please don't hesitate.
Okay, another round of applause, please, for Douglas Abrams. There we go. Thank you. So, moving on to the second and final session for today. It will be a panel discussion to get some reflections from some international VCs on various angles on their work with startups. So while the stage is going to be rearranged, allow me to introduce our other two panelists apart from Douglas Abrams. The first person, Mr. Paul Ark, he is the Managing Director of Digital Ventures. Paul Ark spent the first half of his career as an investment banker, working on IPOs, acquisitions, and private equity deals for global banks such as Deutsche Bank and Citigroup in Asia and also in New York, as well as boutique advisories in Southeast Asia. He then transitioned to the world of retail by joining Central Retail, working on regional joint ventures and working on the company's market entry into China and other Asian markets. He spent several years facilitating Apple Retail's market entry into Asian markets and opening up flagship stores in China, Hong Kong, Japan, and Australia before joining Microsoft and advising on their China retail market entry strategy. Paul is also an active startup mentor and angel investor, having made investments in early-stage companies in the United States, China, and Thailand, and devotes a lot of his time supporting and developing Thai startups as a startup grind chapter director and Seed Stars World Ambassador for Bangkok. He currently manages the $50 million corporate venture capital fund for Siam Commercial Bank's Digital Ventures Group, which has made investments across the globe. So this is our second panelist, Mr. Paul Ark. And then our final panelist is Mr. John Kaaiohelo. He serves as the special advisor to the Chief Investment Officer of Telenor's digital businesses. His areas of responsibility include deal sourcing, valuation, and deal execution across Telenor's Asian markets. He concurrently serves as a joint appointment as a special advisor to the Chief Strategy Officer. Outside of Telenor, John serves as a non-executive independent director at venture capital-backed startups in Hong Kong, Myanmar, and the Philippines. Prior to joining Telenor, John was a vice president in the Hong Kong offices of Guggenheim Partners, a leading global financial services firm where he covered equity markets in East and Southeast Asia. Before that, he also spent several years at Ward Ferry Management, a Hong Kong-based hedge fund. So, without further delay, may I invite on the stage, first of all, Mr. Douglas Abrams, founder and CEO of Xpara and Xpara IDM Ventures. Next, Mr. John Kaaiohelo, special advisor to the Chief Investment Officer, Telenor Group, and Mr. Paul Ark, managing director of Digital Ventures. And this session will be moderated by our one and only Dr. Nan Sethjinda, Program Director of Master of Science in Investment Analysis and Management, Assumption University. Please help me welcome our panelists and our moderator on the stage. So if we are ready, Ajahn Nan, over to you.
Thank you, Kun Pim. Actually, my job today is pretty easy. Well, number one, you know that these guys are exceptionals and they are very smart. My only problem is I cannot catch up with them or probably need to take the mic away from them. And the secondly, the audience. We have some pretty exceptional people here. So I'm sure Andrew will help me ask questions. But I guess we need to know a bit more. The only thing we know is there are more men than women. Give me a show of hand if you're coming from Stratup. Anyone? Okay. Stratup? A few. Investors? I can't see anything really. You have to raise higher. Investors? Okay. Academics? Okay. Others? Okay. Good. I guess the first thing we need to understand when we talk to investor is what type of investment they do. Okay? Since you sit next to me, Douglas, start from you.
So we do pre-seed investment, seed investment, and post-seed or pre-series A investment. And we invest in Singapore, in Thailand, Malaysia, Vietnam, a little bit in Hong Kong and Korea now, but mostly Southeast Asia. I would say very early stage to early stage. Typical investment size ranging from tens of thousands of dollars up to maximum of $1 million, but most average around $350,000 to $500,000. And high growth, high tech. We're not really sector specific, but stage specific.
Okay, John?
I guess we invest typically across most Southeast Asian markets minus Indonesia. We have a very wide pocket size. So our smallest deal to date has been $1 million. Our largest has been $385 million. but typically our deals range from 100 to 200, I'd say, million.
So digital ventures, we define ourselves as a fintech fund, but our definition of fintech, or my definition of fintech, is actually a lot broader than most fintech people would define. So we look at investments that impact different financial products and services, but we also look at a lot of infrastructure investments. So investments that impact data, security, anything that sort of covers basic bank infrastructure or infrastructure that impacts financial services. And we'll even look at deep tech investments. So we've done investments in geolocation, quantum computing. We're looking at areas like augmented reality, things that could potentially impact financial services in the future. The great majority of our investments are outside of Thailand. So we invest off of Siam Commercial Bank's balance sheet. We are a Thai fund, but because most of our investments are infrastructure related, we do scour the globe for our potential investments. We'll do it through two different routes. We'll do either direct investments into startups, or we will invest into other funds, a fund-to-fund strategy that are investing in the types of startups that we do. So our typical fund size can range anywhere between $1 to $5 million for a direct investment, usually Series A and B. So investments that, startups that already have a product and a revenue base. And we will also, and then for our funds, we'll invest anywhere between $3 to $8 million per fund.
Okay, I guess there is actually some, since we are talking about investments, there are some carryover questions from the first sessions. Many of them is actually interested in the kind of return that you make in seed stage versus the later stage. Can you please share with the audience, like what are the typical return, like let's say at the very seed stage compared with like Series A or Series B?
So this is about per company or for the fund?
Funds.
So for the fund, yeah, I think I showed some statistics on that before, but let's say I think a well-performing venture capital fund, no matter what the stage of the fund, would return at least 3 times the original fund. So I think 2 times it's already at the low end, assuming it's a 10-year fund. 3 times is pretty good. 4 times would be very good, and more than 4 times would be excellent. I can say for our first fund, let's say our first fund, which is a pre-seed fund in Singapore, we did very small investments. We did 17 investments. In that fund right now, we have 7.7x return from 2008 until 2017.
So we have a slightly different viewpoint towards return because I think one of the slides that Douglas had alluded to was the difference between a financial VC, which Kesara is, and a corporate VC, which is what Digital Ventures is. Because of that, we generate return through both financial return and strategic return. Financial return is relatively easy to measure. You've got any number of financial metrics, IRR, cash on cash, multiple. Measuring strategic return is it's incredibly difficult because every corporate venture is going to have a different strategy, and so the metrics in measuring that is going to be very different. And it's really hard to quantify strategic returns sometimes. So I actually kind of joke, but it's not really a joke, that when people ask me what my strategic return metric is, it's basically to not get fired. So as long as I still have a job, I assume that I'm generating a strategic return for the bank. But a lot of that strategic return can come in the form of, are we finding technology that we could plug into the bank? Are we investing in technology that is yielding knowledge that we can't get just by reading a research report? Are we making investments into companies that are connecting us to other investors or customers that will become strong collaborative partners in other areas in the future? So we're trying to find more than just the investment return on the specific investment, but it's hard to quantify the value of a good connection or knowledge transfer.
Thank you, Kun Paul. John?
I don't really have too much to add to that. I think on the financial, so by way of background, Telenor is the world's 9th largest telco. We have 220 million direct subscribers in 13 markets. In Thailand, that would be DTAC. In neighboring Malaysia, we have Digi. And also in Southeast Asia, we have telcos in Myanmar, Bangladesh, Pakistan. Adding to what Paul said, I think we think similarly, but at the telco level, we're also looking at things like IoT, which is hard to quantify a return on at this point in Asia. But we have a very large IoT asset called Telenor Connection. It's the 9th largest IoT asset in the world. But we don't, frankly, probably know exactly how to value that asset. It was a homegrown kind of organic thing that we built. But there are measurable strategic benefits to having connected devices to our telco asset. And I think that's a good illustration of how do you value that? And we value that strategically, hopefully financially with an exit at some point. But right now, it's purely strategic.
Okay, thank you. I guess we'll just step back a little bit and take a broader look at the Thai ecosystem. Perhaps let me start from John. We have been seeing a lot of hypes, a lot of buzz around Thailand ecosystem. We'll come back to Douglas and Paul in a bit. Can you share with us what is actually happening in other markets in Asia?
To the extent that I'm qualified to talk about everything that's happening in the rest of Asia, I think, a few years back, I would go to these conferences, not even that long ago, 2 to 3 years ago, and I think the general thesis around Asian venture capital was that it was kind of a copycat market. We would see what works in China, and then you would bring it to Indonesia, because that's the next biggest market, and then you try to see if these business models would work across Indonesia, and if it did, you would move on to the next largest market, which is Malaysia. Maybe these gentlemen disagree, but that was kind of the sentiment a few years back. I think some of that has proven true. The investments into the initial unicorns in Southeast Asia, like Gojek and the Grabs, the Travelocas, the early ones like Razer, VNG out of Vietnam, they do have Chinese roots. But I think what we're finding now is that these Chinese unicorns that have popped up across, Indonesia especially, are now investing themselves instead of waiting for their parent companies to invest. And I think a couple of good examples of that might be in Bangladesh, where we have, I think, Patao, which got 100 million plus valuation directly from Gojek, or companies that are being acquired like Kudo in Indonesia, which again was valued similarly by Grab, but not by Chinese companies.
Douglas, you have had presence in Vietnam and Malaysia. Do you share the same view with John?
So I guess I think all venture capital markets and entrepreneurship markets, they start out copycat, if you think about, and actually even today, because you look in Silicon Valley, most startups are also copycat. The innovators are a small percentage of total startups, so innovators come up with an interesting idea, and then that starts to get some traction, and then many startups copy. So I definitely see there's a lot of copycat startups, I think, everywhere. In terms of the geographical distribution of the startup or what's happening in different countries in Southeast Asia, for me, I only focus on a couple of countries, so Singapore, mainly Singapore, Thailand, Vietnam. So I think we have another partner in Malaysia, but not a lot of business there. So I see mostly Singapore was the first startup and venture capital market to develop rapidly in Southeast Asia, even as far back as like 2000, 2006. Then I've seen a lot of growth in Thailand over the last few years. So I think even we met in 2016 in a startup event here where I felt like we could start to see the beginning of exponential growth of the startup and venture capital ecosystem in Thailand. I think it's definitely met or exceeded all my expectations from 2016 until now. Vietnam, I see, still is also growing really fast, but a little earlier. Like I see many more venture capital funds, CVC, government support, high quality startups in Thailand right now than Vietnam, but I think that could change really fast because Vietnam I see growing quickly. Interestingly, I see Singapore sort of leveling off in the last few years, maybe because of a lot of early success and then for some reason plateauing, and the other two countries that I mentioned seeming to grow much faster. But I think a lot of the different views that people have depends on where are they in the ecosystem. So for me, I'm very much at the ground floor. You know, pre-seed and seed stage is very different from later stage. So I think we'll all have some different perspective based on where we are in the ecosystem.
Okay. I guess my other question that are quite linked to that is that Thailand is actually not alone in building up all these ecosystems, and you just mentioned that Vietnam might as well be growing faster. What kind of risk or what kind of opportunity do you see for the Thai startups? People?
Can you repeat that? I'm trying to, I didn't quite understand what you're trying to drive to.
What I try to say is that many economies are building their ecosystems. They are going for fintech, they are going for startups, hopefully to attract VC investments. We are not alone. From a startup perspective, do you think that, like, in terms of opportunity to scale across the market, is it more difficult or less difficult? What kind of opportunities or risk do you see?
So, you know, ASEAN is kind of an interesting market as a whole. You know, if you look at kind of some of the big startup markets, you know, you look at the United States, and it's a 300 million person market. You look at China, and that's a 1.2 billion market, 1.3, India 1.1, you know, Europe about 600 million. You know, if we look at ASEAN, ASEAN is a market of 660 million, and I think the danger of looking at it like that, if you look at it like that, it's like that's a sizable market. It's a market that's attractive enough to compete with some of these other large markets. The problem is ASEAN is 10 different countries, 10 different languages, 10 different histories, 10 different consumer behaviors, and a history of a lot of warfare over the previous centuries. So, you know, not all of the countries have fond memories of each other, blah, blah, blah. But it's really, for all intents and purposes, it's 10 different markets. You know, I think, you know, some of the earlier conversations we had over the lunch is that a lot of countries in Southeast Asia are in this weird sort of middle zone, in the sense that if you are Indonesia, 300 million person market, China, 1-point-something billion, you know, United States, 350 million, you are big enough that you could probably spend at least 5 to 7 years just focused on growth in your market and still hit the types of valuations and exits that are incredibly attractive without even thinking about going overseas. If you're on the other end of the spectrum, if you are Singapore with about 5 million people, or Israel with about 8, or Sweden with about 9, you know, you don't have a local market. You're too small to grow beyond just a year or two. So most of the startups in these markets are thinking global from day one. And they're geared towards it. If you're an Israeli startup, you're automatically thinking about US or China. If you're a Singaporean startup, you got your eye on the Indonesian market. I think if you look at some of the startups in that middle zone, Thailand, Vietnam, Philippines, you know, anywhere between 60 to 90 million people, we fool ourselves into thinking that our domestic market is big enough to at least sustain ourselves for a couple of years. But in reality, you know, these markets are, our populations are a fraction urban and largely rural, and most of the entrepreneurs in these markets tend to be based in urban centers. So we sit here in Bangkok and we develop the types of apps that we like to use, thinking that the remaining, you know, 59,999,999 people will use the app the way we do, and that's not the case. So, you know, we're in danger. The risk of for ecosystems like Thailand is that we're probably not thinking global enough, fast enough. And so as soon as our startups emerge, we need to start thinking about adjacent markets, even as we're trying to serve the Thai market. So are we going to go into the Singapore market because it's wealthy? Are we going to go into the Indonesian market because it's big? And it's not just as easy as moving across borders, because we're talking about completely different customer behavior, completely different legal regime, completely different landscape. So it's not as easy as moving from, say, somewhere in Europe where the borders are more porous. There's a lot of proficiency in English as a common language. There are a number of different hurdles and risk factors of being a startup in ASEAN trying to scale.
Okay. Actually, do you have anything to add?
I guess so. So I don't invest, or we don't invest directly into Thailand, but one of the questions that I kind of always wondered looking at the overall landscape of ASEAN is and forgive me if this is an offensive question, but why is it, I always wondered, that the region's first travel-based unicorn came out of Indonesia and not Thailand? Is a question I've asked myself a few times. I mean, if you think about kind of the geography of this region, Thailand has, or Bangkok rather, is the world's most touristed city. I think global kind of connections to different parts of the world, I think, are at least on par with a New York or a London, right? All the kind of price advantages that Indonesia has, I think Bangkok and Thailand enjoy probably more. But yet, I remember watching a talk that Paul actually gave in another conference where I think Paul mentioned Thailand has twice the percentage of fintech startups that other markets kind of do. Why is it that Thai entrepreneurs are focusing so heavily on fintech developments and not, say, something like travel, which I think Bain recently did a study that said the digital economy in Southeast Asia is worth $50 billion, and of that, 22 billion go into travel. Why isn't a country that's globally famous for a travel economy not producing more travel entrepreneurs in the digital economy? Why is it that Traveloka is not a Thai company? These are things that I kind of wonder about the Thai ecosystem.
Douglas, you have anything to address to John?
Oh, I mean,
sorry to put you on the spot there.
No, throwing this to you
no, I
because
think it's a good question, but okay, I would look at it. I would answer a couple of ways. One is, I think the fact that Traveloka became so successful and came in Indonesia is sort of, random. Like, we could pick any specific startup and say, why did it start in this country versus another country and succeed? Like, I haven't really followed the whole journey for Traveloka, but why Traveloka in Indonesia versus Thailand? I mean, maybe one reason that Thai entrepreneurs might be focusing more on fintech than travel is so crowded. Like, actually, for me as a VC, when I get a startup coming to me with a travel-related pitch, I'm already asleep. I'm like, oh no, is it really another travel startup? So, but maybe in Indonesia, what I would guess, okay, if I had to make a story about this, or try to develop a story, is maybe the local travel market in Indonesia was not as crowded as the regional travel market already, and so the Traveloka guys were able to get enough traction in the local market to really scale up, and then they beat all the other local competition, and that's why they succeeded there, and now they're able to grow. And maybe in Thailand, because there's still already so many travel-related apps coming from other countries or even local, that the entrepreneurs didn't focus on that so much. One other reason I would guess for focus on fintech, because there has been some public sector support for fintech, and we see this in Singapore too. There's a lot of fintech startups in Singapore because government's pushing fintech, and I'm always a little nervous about sector specificity in startups because interesting sectors change so fast. Like, we did most successful fintech investment we made in 2008, before there was even a category of fintech. So I think by the time the category is so well established that everybody wants to do it, it may be a little late for that. And yeah, I think looking, we're still very interested in fintech, but we're also looking, well beyond fintech at this stage.
Okay, I suppose based on the audience, a certain portion of them is coming from the investment perspective, and a few of them is coming from the startup perspective. So I have two types of questions to ask. One is for the startup. You talked a lot about the angel investors and the messy cap table, and we talked about what not to do during our discussion during lunch. So anything for you to share with them? Let me ask you, let's see, you were seeing a very messy cap table, like angel investor taking 40% stake. How do you sort out or clean up that cap table?
Yeah, it's
Or, sorry, no investment for you.
No, it's very painful situation. And I'm glad we have a chance to talk about that, because I think is something that investors talk about a lot, but not sure that entrepreneurs are hearing enough about it to avoid the avoidable mistakes. So the best way to deal with that is it shouldn't have happened in the first place. It's like prevention. It's much better than trying to cure later, because the cure is going to be really painful. So let's say when we meet the startup where the angel, or let's say I would just put it in general terms, somebody other than, let's say the company is early stage, so they only have angel or pre-seed investment, and somebody other than the active management team has most of the equity. So that'll include all these other cases: angel investor, high-profile advisor, founder that's already left, et cetera, et cetera. So we want to see, and to put some numbers, I would think by the time we see the company for a seed stage investment, the founding team should still have 80 to 90% of the equity. If they have any less than that, it's already a huge problem. And how to fix it, it's going to be, we call, the way to fix it, if it can be fixed, we'll call restructuring the cap table. But restructuring the cap table means somebody is going to suffer pain, because somebody who had a lot of equity, after the restructuring, they're not going to have a lot of equity, and they're not going to get compensated for it in any meaningful way. So that's why you want to avoid it in the first place, and especially if it was a friend or family or somebody that you want to maintain a good relationship with, because it doesn't help them and it doesn't help you. When it gets restructured or fixed, it's going to be at the expense of somebody who's not going to be happy. So, yeah. If we don't fix it, it's going to get worse in the future.
You smile. You have anything to add?
Because I've done angel investing in several different countries, and I think a lot of what Douglas was alluding to during his presentation is that the way business operates in the startup space, especially the early stage startup space, is very, very different than what most of us are accustomed to as traditional investors. A lot of us have probably done our own investing, on the stock market. Many of us as corporates, if we're investment bankers or corporate developers, we've done acquisitions. We've used all the tools that we've learned in an MBA program. And I always say that in the startup space, the traditional laws of business physics don't apply. But the problem is, I think we come out and we're hotshot bankers, PE guys, we made money as day traders, and we think that knowledge is transferable to the world of startup investing. And the truth could not be more different. So, we're in an ecosystem where there is a phenomenal amount of education for startups through accelerator programs, for would-be entrepreneurs through entrepreneurship classes. We don't have enough education for would-be angel investors. And so what happens is you get a sophisticated investor in terms of stock market, currencies, artwork, whatever, and they get very enthusiastic about a startup. They see a startup pitch, they're very enthused, they want to do something. The startup would love to see an investor, maybe they're a big name, high profile, celebrity, and they want to do a deal too. The problem is you're matching a relatively unsophisticated, from an investment point of view, entrepreneur with a relatively unsophisticated investor who has never done startups. And so it's not that, they arrange terms because, the investor has the leverage and they're greedy, but they're both could very well be well-intentioned. There's a lot of passion, there's enthusiasm, there's a chemistry there, and then they both do a deal that is messy, the valuation is shot to hell, and then you run into the same situations that Douglas alluded to, that someone's got to come in and fix it. Or you come in at a valuation that's too high, and so the next round is actually going to be below the previous round, which the angel investor probably won't want to do. And so, you know, in a lot of those cases, again, there are some investors that will come in and actually help startups work their way through those issues. But for the most part, a lot of investors can't be bothered. They'll just say, you know, great potential, not going to bother cleaning up the cap table. We see too many of these deals in Thailand. We'll continue hunting in Indonesia for a while. So, you know, I think when our ecosystem asks those rhetorical questions like, is there enough money? Why isn't there enough VC in this market? You know, I don't think there is a drastic shortage of startups. There's a lot of startups out there. There could always be more. There needs to be more startups. And there's a lot of money, even at the early stage, in the form of high net worth individuals. But I don't think there is enough education in terms of angel investing. And I think to some extent, I think Douglas is trying to improve the knowledge of how to think about early stage term sheets. I think there needs to be more of that so that when we match angel investors with entrepreneurs, both of them are a little bit more wise to the types of terms that will not only result in a successful investment, but will actually carry the terms to the next round when you need to attract new money.
Okay, thank you. But
I want to add one more point on what Paul said, building on that, because I really see there were two types of cap table problems I wanted to highlight. One is early investor has way too much equity. Second cap table problem is early investor has way too little equity. Why do they have what does that mean? Let's say instead of they put in very little money or did very little and they have 40%, they put in actually a pretty significant amount of money, they have 2%. So this is another case where in most of these cases, almost all, I believe, everybody's trying to do the right thing, but they just didn't have enough information. So what happened was they put in, let's say, 10 million Thai baht and they have 2%. And now the company is way overvalued in the next round. And the problem we're facing here is it's going to be a down round for all the existing investors. And probably they were friends of the founders. That's why they were willing to give maybe one of the reasons they're willing to give such a good valuation. Now for us to come in, we have to cut the valuation by half or 75%, which means the existing shareholders, again, they're going to take a huge hit. And that's not the situation you want to be in. So one problem, the early investors came in way too cheap. The other problem is they came in way too expensive. And again, both of these are, central to our topic today of valuation. So if the best, and sometimes startups might think, oh, it's always better to get a highest possible valuation. I didn't cover that today, but that's, I think, also not correct. It's good to always get the highest possible reasonable valuation. So when the startup gets too high of a valuation, existing investors, are going to get hurt in the next round, or maybe they can't even raise the next round.
Actually, can I add one more point? We're just playing off of each other. But I think when an entrepreneur gets together with a potential investor, they're spending a lot of time focusing on each of their two interests. But what I think they're forgetting is that they're forgetting the interests of the investors that came before, and they're forgetting the interests of potential investors that will come in the next round. So any deal that you do with a potential investor, you also have to ensure that you want to make sure that the investors from the previous rounds don't get completely screwed over. You want to come up with a deal with your current investor that will give that person an attractive enough return in the following round. And then you want to create a situation where new investors can come in, where they can expect a decent amount of return when you go to the round after that. So, it's always that chess game where you have to think in multiple dimensions, and you have to think of multiple constituents' interest. Because all it takes is one potential constituent to not be happy with the deal structure, with the valuation, and the ongoing process of going from C to A to B, it stops somewhere. You hit a brick wall. So it's thinking just beyond the immediate scope of your discussion with the investor in front of you. And you have to think a little bit 360 and a little bit further out in time.
But I suppose to the startup, this is going to be difficult for them, right?
That's why startups are hard.
Everything is difficult.
If it was easy, everyone would do
Let's
it.
say, for example, if I have a brilliant ideas, I only know that I need to convince you guys to give me money. I wouldn't be able to figure out the cap table and how much would be the appropriate shareholding structures that would be interesting for the subsequent round of investors. Can you give one common terms or standard number? Say, for example, the equity stake that the early investor need to have. What is the approximate or appropriate percentage?
I would say in every round of each round of investment, early or middle or late, and typical investors expect to get somewhere between 10 and 30%. Now, sometimes might be a little less, sometimes might be a little more, but if I was an entrepreneur and I wanted to have like a single figure in mind how much equity should go out to an investor in a normal investment round, I would say 15 to 20. If it's a lot less than that, something is wrong. If it's a lot more than that, something is wrong. Unless it's a super exception case, like it's Facebook selling 3%, when they're already valued at $50 billion. But normal investment round, somewhere around 15 to 20%.
15, 20. People, any magic number from you?
Okay. So first, I'll address the first half of your question. That it's a challenge for entrepreneurs. It's bewildering. This is a complex thing. In most circumstances, you have an investor that might have, or you have an entrepreneur that has some idea of how to do funding, but they're constantly talking to a number of VCs that are fairly sophisticated. So it's incumbent on the entrepreneur to learn the process, learn the terms, but by virtue of talking to several smart investors, they're going to get kind of a sense of what is standard market practice. The problem with early ecosystems like ours is you have a relative lack of experience, knowledge, and sophistication on both sides of the table. And that's where, like I said, you could have two sides that are incredibly well-intentioned that wind up inadvertently shooting themselves in the head. There's a saying in the U.S. that the road to hell is paved with good intentions. It's not enough to have good intentions. You need to get intelligent about this. So, that's why, my view is that we try to train, you want to help the entrepreneurs as much as possible, but they're trying to learn 100 different things: growth hacking, hiring, business model, monetization. The easy part is going to the investors, the ones that are new to angel investing, startup investing, and let's start educating those people on how to be smarter angel investors, so that they can create deals that will be of long-term benefit to both sides. Now, I think to the question in terms of numbers, I think one, it depends on the stage, obviously, but I think whenever we look at a deal, some basic rules of thumb is, and especially this gets to messy cap table, is if I see a core founding team, assuming that it's usually like the 2 or 3 main co-founders, if they get diluted below 50% before they even get to the A round, that is a complete deal killer. I would not expect to see a startup where the founding team falls below 50% until after A, preferably after B. So that means you work backwards and figure out how much dilution you as a founding team are willing to accept up to a certain point. After that, it's, and I think that's regardless of the company or industry, because at the A rounds and the B rounds, this is still a highly volatile business that you're in. You haven't locked down the business model completely. You're working on adjacent markets, adjacent products. So this is not a situation where you want to see a founding team that doesn't have enough incentive to work their butt off for the next 18, 24 months. If you have a founding team that only owes collectively 20%, these guys might say, this is really too stressful. Why am I even doing this? It's better that I walk away from my 5% share than it is to bust my butt for the next 2 years on this. So you don't want to see situations where they get disincentivized.
Okay, thank you. Kun John?
Nothing else to add to that.
Okay. I suppose before we moved into the questions from the audience, what are other things that startups are not to do, the what not to do? Anything else aside from messy cap table, too little equity stakes to the founding partners, too much equity stakes to the angel?
Oh, okay. My other favorite one that we see a lot in Thai market is all founding management team members must be full-time. So what they so what the startup shouldn't be doing is the CEO should not be running another business. They should not be like, there shouldn't be any management team members who are not full-time 100% on this company. That's a pretty common situation that we see. If they, okay, one template, like they're running, for example, software development company that's doing contract development, and now they've developed some interesting software that they're launching as a product, but they want to maintain their operational role in the development company because it's generating revenue that's funding the development of the product, but it doesn't work like that. So they have to be full-time on the company that they're raising money for. I always tell the startups there's only two, like the founder will say, no, don't worry, I'm 99% on this startup. But 99%, it's not 100%. So there's only people who are 100% and zero. Everything short of 100% is zero. So they have to focus 100% of their time on this company. And then more sophisticated argument is the entrepreneur will say, but what about Elon Musk? Because he's running, both SpaceX and Tesla. And then I say, yeah, soon when you have accomplished as much as Elon Musk, then we'll definitely invest in you. And you can run two companies, but right now, it doesn't work like that. So, focus on that one company now.
Okay, 100% full-time. Douglas, people?
I would say don't start talking to investors at the last minute. Again, as an entrepreneur, you don't want to be constantly fundraising. Your job should be building your business. But, I think the problem with most entrepreneurs is that they spend 0% of their time talking to investors most of the time, and then 2 months before they run out of cash, they're in a frenzy to find an investor. And usually because they don't know any investors, they haven't begun talking, they will take any money that they can find, usually. And, you're desperate, investors can sense that. If you spend enough time building relationships over time, you'll kind of get to know how investors think. So you'll be able to prepare yourself, like, is this the right time for me to raise money? What kind of valuation can I expect? How much control am I expected to give up? You're going to start to know that, okay, that's the type of investor I want on my cap table because they know my business, they have contacts, they can introduce me to people. I want to avoid those guys because they're gonna rob me blind or they're not going to add any value. At the same time, starting that conversation gradually. So just maintaining relationships over a period of time gives investors a chance to get to know you over time and see your business grow so that by the time you actually do need to raise money, you're not spending a lot of time trying to sell your business or trying to prove to investors you're worth a certain valuation. They'll know you by that time. So, always be networking.
Okay. I have one question, which
before
that.
One small thing. So it often surprises people when I tell them that even at like $100 to $300 million deals, maybe even especially at $100 to $300 million deals, because of the way that ultra high net worth families tend to dominate Asia, which is one thing we all talked about at lunch. Your corporate governance, making sure that you and your investors have thoroughly spoken about what your goals for the company are and how you will exit, and you'd be shocked at even very large size deals when we talk to management and then we talk to the typically family that controls that asset. They have wildly divergent views on what the company should be doing. And even at an angel investment stage, which I guess I've done a little bit, to usually someone very wealthy that backed them, and that person will view this startup as their own personal asset that they use to make their other core business better. And meanwhile, the founders think they're reinventing the internet. And this issue, those investors will not get along, which would be bad. And number three, you may not have the ally that you thought you had in your original investors, and you won't know it. So at the very beginning, I think, and it goes to what Paul is saying and what Doug is saying on the voting rights, not just the economic rights. There's so much focus on economics and valuation. Make sure you understand really what these people want from you, your time, your co-founders, and communicate early on so that you don't just hear one meeting and what they say and then build a whole company around it.
Yeah, I have one question that the audience will like, especially the investors. You mentioned in your presentations that you're looking for the company that will give the technologies or a service like a Starbucks today that nobody knows about. What are some of the things that you look for when you invest in startups, like your choice of investment? What are some of the very thing that you see, this is going to be my 5 years Starbucks?
So how do we evaluate the startup for investment, right?
Yes.
So
How do you pick your winner? Or is there any particular things you always look for, and that's always?
So for me, I look for innovative product that solves a painful problem for customers in a fast-growing market with a good market entry strategy, ability to create barriers to entry, a strong team to execute this, and a reasonable financial offer.
Douglas, this sounds too typical.
No, but this is really what I do.
No, I mean,
okay.
give me example.
Okay. But so that's what I look at. But I'll tell you how to make it easier, how I like to pick the investment. So these are the quality I look for. But the way most important for me about picking the investment is the team. So if I like the team and feel confident in the team, then I'm interested to invest. I mean, usually I look at the team first. So I think, is this a team that can really create a successful company using our metric for success? And then I think about, okay, and how innovative is their product, and are they solving painful problems? So I always look team first.
Okay.
And not all investors do this. Some investors look product market fit first, some look team first. I always look team first.
Okay.
The example for me, when I look back over all the investments that I and we have made, in startups since 2007, the most successful companies all are the ones that were, in a way it's a little circular, but the most successful companies were the ones with the strongest teams. And why do I think that's so important? Because product market fit can be changed, with pivots. We talked about that before. But the team cannot be changed. We can add or subtract people from the team, but the core management team is the key driver of success for the company. If they encounter a problem and they pivot, then strong management team, the right team can do that. The wrong team, they're not going to do the right pivot. So I think for me, I highly prioritize team.
Thank you. John?
Well, obviously at the $100 million plus M&A kind of level, your team has gotten you fairly far. So it's hard to, at that point, take people out. That's not going to happen at a gigantic acquisition stage. I actually, at smaller deal stages, to the extent that I have experience in that, I strongly reiterate what Douglas just said. Team, absolutely. No real science behind that. I'd say, especially in markets that are quite diverse, where you will have basic bottlenecks in things like paying for stuff online is a bottleneck. Logistics, getting products to your customers is an issue. I know there's a lot of talk about innovation, and typically the implied understanding there is that it's intelligence To be innovative requires intelligence. My hunch is that being innovative actually requires you to be sympathetic and empathetic to your customers, not smarter than them. And trying to execute a business strategy that hinges on you understanding your products actually is a very strongly team-dependent thing, not an intelligence-dependent thing. So I think making sure the co-founders are versatile. I think it's hard to say that they should be smart or not smart. I mean, that you want to see smart, you don't want to see dumb. But making sure they're extremely versatile in a lot of situations. I'm actually a really huge fan of the book, The No Assholes Rule. It's written by 2 Stanford professors whose name I can't remember right now, unfortunately. But that book, I think, says it really well, is, you know, you look for all the typical things: drive, ambition, background, you psychoanalyze, but you make sure no one is really an asshole. And I think the theory behind that isn't just, of course, nobody likes assholes, but the theory behind that is if you are an asshole, you cannot have the empathy required to drive the innovation necessary to really build a company.
I wasn't going to talk about team as a factor because these 2 gentlemen did, but I do want to build on that before I talk about the other thing I was going to say. The important thing to understand about team is that it's beyond just the stuff that you can measure. It's not, oh, okay, where did they go to school? How many years of experience? You know, did they work at McKinsey or Goldman Sachs or Google? A lot of it is a very, very cultural, social, chemistry element. So I think when these guys look at teams, it's not just IQ, it's also a lot of EQ. And that means that I think investors are going to judge on the chemistry between the core team, and they're going to judge on the chemistry between the investor and the team. You know, because I've actually looked at investments where, from a pure technical perspective, on paper they look great, but yeah, you're going to work with, you know, this person is a thoroughly unpleasant personality. And so if my job is to try and work with them and develop a strategic rapport and get knowledge from them, I could sit there and say financially it looks good on paper, but I'm never going to be able to effectively work with this person because the chemistry isn't there, they're annoying, or they don't like me, vice versa, whatever. But that's the part on team. I think one of the things that I also look for, because we're strategic fund, so we're not just looking to invest in things that will return a lot of money, although we would love that, but we're looking to solve very specific problems to the bank. And so I can't tell you the number of times I've talked to entrepreneurs who are not able to thoroughly articulate the problem they're trying to solve and or the solution to the problem and or why their solution is better than everyone else's. You know, I do meet a lot of entrepreneurs that have incredibly cool looking tech, and they develop the tech and then they try to find a problem that it'll solve. They try to force their solution into a problem that may not exist, or it's kind of hard to see the value of that. So, you know, when we develop a thesis, you know, whether it's, you know, blockchain, whether it's, you know, cybersecurity, whatever, we'll identify in the bank either an existing problem that the bank has and we need to fill in the gap, or we will project out in the future and say this is going to be a major area of weakness for us 5 to 10 years out. So maybe we start in looking at technologies that might address that, and then we will go look for technologies that address that problem. And so it's very, very important for entrepreneurs, you know, to be able to go after the right problem and have the right solution. That's you know, in the startup world they call that product market fit. If you don't have product market fit, you're probably doomed to fail. And I think between team and product market fit, that probably accounts for about 40 to 50% of why most startups fail, is one of those 2 problems.
Yeah, it sounds like, you know, we are pushing products, yeah, which is very traditional issues that the traditional business model is having. So now let's turn to some of the questions from the audience. The question that has received the highest number of votes is, would you consider investing in Stratup, which is a pure Thailand play? Thailand play.
I thought it was going to be about ICOs.
Perhaps like focusing only on Thailand. I think they'd probably like to hear from Kun Paul.
Okay, so the tricky part is okay. So if I take it to its natural extension, I could probably say yes for a very different reason than I normally would, because again, if I were a financial VC and I need to maximize financial return, I need to see a large market, a very large market. 60 million doesn't cut it. And so if I were a financial VC, I would say no. But I am looking for solutions that solve the bank's problems. And if you come up with some sort of enterprise solution that addresses customer onboarding, KYC AML, that's know your customer, anti-money laundering issues. If you can help me solve the bank's problems at an infrastructure level, it probably doesn't matter if you're a pure Thai play. To be honest, you could view yourself as a Thai play, but if you're solving that kind of problem for a bank, that's a problem that's common to all banks. So in a way, you wouldn't be a pure Thai play. You might only focus on, okay, I'm creating a product just for Bangkok Bank, Siam Commercial Bank, K-Bank, but in reality, most banks have the same problems at an infrastructure level. So that's kind of a half-assed yes and no answer. But if you're solving a problem that directly gets to the core of what I'm dealing with, even if you're all Thai team, if right now your revenue base is Thailand, yeah, I'll look at you.
Thank you. Douglas?
I have a little different answer for this question. I would say, would we consider investing in a startup which is a pure Thailand play? And the answer is absolutely yes, if you can generate required return. So for me, I don't care if it's Thailand play or regional play or global play. I mean, of course I care, but I only care insofar as it affects the required return. So if you can generate my 30x return in a pure Thailand play, I'm all over that. Now, of course, that's not an easy challenge, but that's going to have two factors. One is the valuation now. So if it's appropriately priced and you can exit at a level in a pure Thailand play in this market that generates the return, I would definitely do it. Now, of course, you have to convince us that you're able to do that, but if so, yes. And in fact, in our current fund, which is our expired GSB fund, we have a very strong preference for investing in Thai companies. Actually, every company that we invest in has to either be established in Thailand or have a very strong Thai focus. So we look specifically at that. But I would say unreservedly yes, if you can generate the required return in Thailand.
I mean, I have similar thoughts. I think this question at its heart shows some kind of insecurity about the size of the Thai population and the Thai market, right? I mean, I think if you look and step back at sheer numbers, the top 5 kind of cities in ASEAN put together equal in population the top 5 cities in India, but at a GDP per capita that is 5 times greater. So, if you can scale across India, and arguably that's many different countries put into one boundary, India. If you can do it there, then you certainly can do it here. And likewise, lifestyle-wise, I'm going to assume that many of you have traveled across Southeast Asia. If you look at life in Bangkok versus life in Kuala Lumpur versus life in Jakarta, there are differences. But by and large, what we're seeing is similar consumer behaviors with similar brands. There are local players, but we all recognize the same things. So if you can scale in Thailand, and by that you probably mean Bangkok, then probably you have a reasonable hope of scaling across major metropolitan areas, I think, in ASEAN.
I'm going to qualify that statement with it depends on which segment you're in. If you are a ride-hailing app, it largely functions the same. You're basically trying to order a taxi. But if you're, say, we're going to do mobile commerce and we're going to use some sort of messaging platform, people in Indonesia are going to shop on different types of platforms, and they're going to do payments in very different ways on different messaging platforms than they would in Thailand. You know, Thailand is one of those areas where there's a really good balance between the large e-commerce platforms, you know, like Lazada, as well as individual storefronts on Instagram and Facebook. And you know, that's a very different shopping behavior than I think in other parts of Asia. Also, we're probably one of only 4 countries in the world where line is the dominant messaging platform. So that creates a different mechanic for payment. So I think it depends specifically on the area of business. I think there are a lot of things that you could probably easily transfer from Bangkok to KL to Manila and whatnot. But I think there's others that are very, very culturally specific.
Yeah. I mean, if I could just add one thing to that, and I'm glad you brought it up, Paul, is I have to be careful what I say because we are a publicly listed company, or I represent a publicly listed company. So Telenor is 54% owned by the Norwegian Sovereign Wealth Fund, and we're listed in the Norwegian Stock Exchange. Full disclosure for the cameras that are rolling. And of course, DTAC is a public company listed in Thailand. So with that disclaimer, I think maybe I can say we actually asked ourselves the question, why did Line succeed in Thailand? Why Line and not Viber? Facebook Messenger and WhatsApp certainly have more money. Do they have cooler stickers? Is the Thai font cooler in Line? And I think one of the conclusions we came to after some focus groups and kind of surveilling the market here is that there was a sort of virtuous circle both in time and behavior that happened between Line, Instagram, and Lazada, where predominantly Thai females would chat online, talk about what they saw on Instagram, you know, like it, buy it on Lazada, thank the person through Line, then like their thing on Instagram, and actually all 3 rose together. Now, I think a lot of you, especially few females, there should be more, are kind of smiling because you think that's obvious. That's a no-brainer because you do it in your lives every day. But to us, it was a revelation. The idea that 3 different apps could rise in one ecosystem together to support each other was actually a complete revelation to us, where we're in 13 markets, and that knowledge isn't just a Bangkok only, you know, you're a small startup, you have no chance at scaling. If you are a startup that works in the OTT space, or if you are an empathetic, innovative person who understands Thai consumer behavior, who caught that, you would be able to use that knowledge to scale across markets in an innovative way. And I think, you know, I'll shut up after this. If you look at what Shopee does and why they've succeeded, look at what they actually do in their program. They actually have chatting combined with liking, right? Combined with e-commerce in one platform. And I don't want to go on record as saying they copied, because it's a fine application that's doing really well. But clearly they studied consumer behavior, and there's no reason that had to come out of a startup funded in Singapore. If you were a startup working in any of those spaces, e-commerce, chatting, or social commerce itself, you yourself could have had this realization. You know, so don't limit yourself into thinking I'm only Thai, this valuation is small, this market is small. Think innovatively about consumer behavior, and the rest, I think, will follow.
Okay, I will probably stay with questions that relates to Thai startup for a bit. There are quite a number of questions on how to invest in VC and what are your views on ICO. We'll come to that a little later. I think this is good. Investing in many regions, what do you or your venture see are Thai startup competency against global competitors? I suppose this question would probably be, are Thai startup able to compete against global startups?
Okay, so I'll address that with a very specific example because, you know, I work with an organization out of Switzerland called SeedStars, which is a global seed stage organization that hosts pitch competitions in 70 developing markets around the world. And the winner of each of those markets go to Switzerland to compete for equity funding. I think the main prize is, main award is about $500,000 US in equity funding, and then there's any other types of awards. So I actually I kind of joke about it. I said this is kind of like the Seed Stars Finals in Switzerland is like the Miss America or Miss Universe of seed stage companies, because you're basically taking the top seed stage company in each country competing. And you look at who's on stage, these 70, these are the top folks in the world. And again, I look at our Thai startups and they can compete. You know, they may not win number one, they're going up against 70 very tough competitors, but they're holding their own. Because of specific arrangements, my wife and I, she also works with me on this, we were able to actually bring not just the leading company from Thailand, but also the number 2 and 3 company. Not to compete for the main prize, but they were able to compete on some of the side stages for other awards. The number 2 and number 3 company actually tied for number 1 out of about 30 other startups on that stage. So, you know, I would say, I would say the average Thai startup probably could do a lot better in terms of their ability to present, think through their business models. You know, I feel like we are struggling to raise the profile of the middle part of the hump. But on the extreme end, the top startups in Thailand can compete with the top startups anywhere in the world.
Douglas, you share the same view?
Yes.
Okay.
I think it's I think Thai startups are average quality of Thai startups. It's I think comparable to average quality of Thai startups in the other countries in the region that I'm involved in. Yeah, it can adjusted for stage of ecosystem development, and then definitely at the, you know, of course, average startup, it's not that interesting for VC, so we're always looking at the top startups, and I think the top startups in Thailand are as good or, you know, comparable to, as good or better than startups anywhere that I've seen.
My last question's on startup. Is there any existing Thai startup who could possibly become a unicorn?
Oh, one thing I think this whole unicorn thing is not important. You know, actually, like because unicorn is arbitrary. You know, the definition of a startup that reaches a 1 billion valuation, that's not, I don't think that's especially meaningful. It makes, you know, it's fun to talk about and makes good news, but I definitely see I know, and we are actually invested in Thai startups that have already reached valuations over 100 million US, which for me, it's the more meaningful point. And so not only are there any, but definitely I know of, and we're invested in startups that have already done that. So I think the reason this, I think, unicorn number developed because US venture capital funds are so big, the size of the funds are so big that in order for them to generate required returns, they need to exit above $1 billion. But for Southeast Asia venture capital funds, especially early stage funds like ours, I think it's not necessary at this point. So yeah, and that said, I'm sure that in the longer time frame, there will be Thai startups that reach $1 billion, just like they've already reached over 100 million now.
Yeah, I mean, I would agree with that. You know, I hate the term unicorn. I hate the focus on it because it puts too much focus on how much money you are getting out and not about building your business. I think to Douglas's point, it was a number that was developed in a market with very different economics. I think if you were to basically highlight some of the top VCs in the world, the guys that you said, they built great businesses, they exited, they became top VCs. Very few of them actually did billion-dollar exits before they became world-leading VCs. You know, I think the number, if you look at Paul Graham, who founded Y Combinator, his exit was a $40 million exit. And he's like the top of the VC game, the accelerator game. He didn't have a $1 billion exit. He didn't even have a $100 million exit. He made $40 million, and I'm sure he's really, really comfortable with $40 million. So yeah, I say instead of focusing on valuation, focus on building a business that basically solves a problem, that you can dominate the market, You can get your company to where you want to be, have a good time doing it, because if you're not having a good time building your business, I don't know why you're doing it. And you meet all of those things, you'll probably be doing really well, and you might even become a billionaire. But I don't think anyone is in it just to hit a certain number.
Yeah, thank you. Unicorn doesn't really matter. Now, two last questions. I think many people in this room are interested in investing in VCs. So there are a few questions on I think in Thailand, is high net worth individual allowed to invest in VC funds? I know that in the US there is.
Yes. So I would say institution for financial VCs, yes. Generally, a lot of the really active funds in Southeast Asia. So I don't know how your investor base looks like, but if you look at some of the ones that are active here in Southeast Asia, whether it's 500 Startups, Golden Gate Ventures, Open Space, Vin Capital, all of these folks raise from a combination of other institutions as well as from high net worth individuals or families. The challenge is, in fact, I know a lot of these funds would love to penetrate family money here in Thailand. The only problem is you approach a lot of these family-owned businesses that are still being controlled or decisions are being made by patriarchs or matriarchs that are in their 70s, 80s. They don't understand VC investing. They know how to these are people that knew how to build billion-dollar empires either on their own businesses or investing in the stock market. They have very, very little concept of, okay, in order to generate this kind of return that Douglas was talking about, we got to invest in a whole bunch of companies so that only 4 will actually succeed. I think once these families kind of understand the math behind it and understand the risks, then I think we're going to see a big unlocking of wealth pouring into VCs. But I think that is the biggest hump right now, is investor education.
Definitely high net worth. Anybody in Thailand can invest in venture capital funds or make venture capital investments. We have Thai investors in every one of our funds from Fund 1 until now, so I know that for a fact. We have funds that are open for investment now, so we're happy to talk to any investors that are interested in funds, and also can refer investors to other funds if they're looking for that. So there's no restriction on individuals investing in venture. Now, for certain types of funds, there might be like the sophisticated investor requirement, but this also applies mainly to larger funds. So, and depends on jurisdiction.
Thank you. My last question will be on ICO. And the reason that I'm asking this is because we have a pretty interesting conversations during lunch, and Khun Paul has shared a very interesting views about ICO. So there are actually 2 questions. One is, can we apply, or can the audience apply VC investment approach to ICO investment? And the other is, what is VC views on ICO? I think just give them a generic views on what you think, on what's your take on ICO.
Do we have another hour?
No.
Okay, so I got to be very careful how I answer this question because like John, I'm connected to a publicly listed company. It is a bank. I can't say that my view towards ICOs mirrors the view of ICOs towards the bank. So I'm not here to give investment advice. It's undoubtedly a phenomenal amount of money has flowed into the blockchain world through ICOs. If you ask me how to value an ICO, I will say I have no idea. Simply because we talk about the difficulty of valuing an early stage startup that might have a product, may not have a revenue model. A lot of times these ICOs are, companies are raising ICOs to build something. So we don't even have a product yet. You give us money, we're going to build this network, and the coin does this, this, and this. Okay, I don't know if that means that there's any sort of validation. I don't know if the technology will work. I don't know if there'll be a market beyond that. That's like me saying to you, I have an idea. I don't know if it's going to work. Will you give me $100 million? And you're going to sit there and say, okay, I need to value it. It's like, I don't know where you start. And I would say that's not all ICOs, but there are some ICOs that are developing some sort of utility connected to an existing business that the company is doing. And I think a lot of early ICOs were done by startups, blockchain startups that had an existing business, and they were building out networks connected to that business. But you're seeing an overwhelming majority of new companies coming onto market that didn't exist before they raised their token. It's just a bunch of people that got together, wrote a white paper, raised a bunch of money, and who knows what they're doing with that money. So that makes it very difficult to assess value a token. And basically, I guess the best value of that token is what it trades at on the markets. Now, I think the VC view towards ICOs, I think it depends on the VC you talk to. I think conceptually, I like the idea of ICOs in the sense that if you break down ICOs to its basic component, it's basically a company that's raising money on the blockchain through digital means. That's actually, I think, the potential future for IPOs in general. Because right now, IPOs involve a lot of paper prospectuses. It involves, management teams getting on planes doing road shows. It involves a sales team, basically getting on phones. I think that's largely how companies raise money in the public markets. For the last 50 years, it's antiquated. Digital distribution of securities is going to move to an ICO model. But ICOs now, companies that are just raising money with nothing but a white paper, no assets, no validation, that frankly smells like a bubble to me.
You smile. Do you have anything to add, both of you?
You first.
So yeah, I think I also have some mixed view about ICO. I think, first of all, I think blockchain, it's incredible innovation, and I'm very bullish on that. ICO, I think, is also very exciting innovation in finance. So I'm interested in ICO. I think it's has potential in the long run to be a valid way for companies to raise money. But I think ICO, although it has two of the same letters as IPO, it actually has nothing to do with IPO. So IPOs and ICOs are totally different. ICOs and venture capital investments are totally different. ICOs do not, when people buy tokens in an ICO, they don't acquire fractional ownership in a company. So they're not equity driven. The investment in, at least the vast majority of ICOs, the potential value in the way ICO, at least my understanding, ICO investment works, when you buy a token in ICO, you're investing in the belief that that token will increase in value, that it'll increase in value in secondary markets that is traded in. So that's a interesting way to try to make money, but it has nothing to do with venture capital investment or IPOs. So I can see that that this same mechanism could be used in the future as a channel to raise money through sale of equity, but right now it's mainly, as far as I understand, focus on a view that the value of this token is going to increase in the future or not. Now, how do you form that view of whether a particular token is going to increase in value once it's traded, I think is a very different exercise from what we're doing in VC, which is look at companies, try to evaluate which companies are going to be successful and how much we can sell them for in the future. So I would see ICO as very interesting, but totally separate type of investment from VC or investing in companies through IPOs who are going to be publicly traded companies. So I think it's important to keep those two straight. Keep it clear what you're investing in ICO, what you're investing in venture capital or IPO.
Thank you.
I guess I'll just have kind of two sets of thoughts. I guess my personal thoughts and kind of quote-unquote professional thoughts. I think on the personal level, I agree with Douglas. I think it is a completely different skill set on how to evaluate ICO investment versus equity VC investment. I think is a totally different skill set. And frankly, on a personal level, the only kind of ICO investment situations that I feel even remotely qualified to look at on a personal level. It might be gambling, ICO gambling situations, video games, which is arguably the first digital token, buying a sword for 100 gold coins in Final Fantasy or something like that, and remittance. I think those are the three where I understand why a digital token or a digital economy would develop and what the kind of forces of supply and demand are. Beyond that, I am totally clueless. On a professional level, I guess I would ask those in the crowd that are considering ICOs, if you're an entrepreneur, I can kind of speak to you, I guess, from an M&A perspective, given my current job. And again, to the extent that I can talk about it, I'd say when big corporates like Telenor, when we discuss coins, like altcoins or the digital economy, you have to ask yourself, I think, will you ever have to raise money again? Because in this kind of, in Southeast Asia, your potential for exits at the IPO level, which is what Douglas talked about, is pretty limited. Basically zero. I mean, there's been one on the NASDAQ, and even Gojek is having problems trying to IPO in Jakarta. So now you're left with strict corporate M&A kind of exits, or what Douglas is calling trade sales, which would be us, or someone like us, which is your exit. How do we value your coins? How does the Norwegian Sovereign Wealth Fund value your ICO coins into our share price listed on a traditional equity stock exchange? Do we mark to market your coin every day on our balance sheet? Do we put it aside into a special purpose vehicle and we only mark that quarterly? If we do we have to declare a special, do we have to issue special announcements on the stock exchange every time the coin loses whatever the maximum loss in market value is, 20% or whatever? Do we have to stop trading our shares every time that happens because we acquired your potentially fabulous, potentially successful, but highly suspicious ICO-based startup? This is always my question, is what do you do? So if you raise, and Paul and I are having discussion, if you raise, say, $1 billion in ICO, one, you better be honest because you can run away with it, because I don't own any shares in your company. Two, even if you were to do that, use that money for something, that had better be all you need to raise. You know, unless you're going to ICO again forever, which raises new questions about how many use cases do you really need, how many coins do you really need in your economy? So please think through these issues. I think some people, frankly, when I look at the market, they're viewing ICOs as just an exit in and of themselves. There is no further funding rounds. But I suspect that's not the case. I suspect sooner or later you're going to have to raise money again, and even at exit you're going to run into issues.
Well, ladies and gentlemen, I hope you enjoy the panel discussions as much as I do. Some of the key messages or some of the key takeaway from today, well, number one, Thai startup, the top tier, is definitely competitive compared to the other global startups. Number two, be careful of your messy cap table. Don't give too much equity stake to your angel investors, and the founders are supposed to have at least 50% equity stake. Teams is important, and I think build a company that you're passionate about, that really solve the customer problems, and really don't worry about being the next unicorn. Ladies and gentlemen, Kun Douglas, Paul Ark, and John, a big round of applause, please. Over to you, Kun Pin.
Thank you so much, Ajahn, and what a valuable afternoon we have today. So this brings us to the end of today's seminar. Just a moment ago, we have sent a link for the satisfaction survey. So please give it some time. Please let us know what other topics you are interested in. Please let us know any feedback you have of the event. We would really appreciate. And what else do we have? So anyone who has brought their cards, the e-stamp is at the reception desk, and the lucky draw for 50 copies of this book is right in front of the room. And finally, on behalf of the Stock Exchange of Thailand, I would like to express our deepest gratitude to our speakers, our moderator, and of course, everyone in the audience today, as well as those that are watching live on Facebook. We hope you all enjoyed the seminar and have a good evening. Thank you.